3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Good morning. My name is Marcus Noland. I am the Executive Vice President, Director of Studies at the Peterson Institute. The Institute is delighted to again be partnering with CEPR on significant research on a crucial policy issue. We are grateful to Kristin Forbes, Ángel Ubide, and Bill English for bringing together a wonderful group of speakers today, and even more so for their great collective effort of the scholar practitioners in the volume that they have produced. These papers will be available for free download on both the Institute's website, PIIE.com, and the CEPR website. I will now introduce Ángel Ubide, who will in turn introduce the other distinguished participants. Ángel is a managing director and head of economic research for global fixed income and macro at Citadel LLC. After starting his career at the IMF, Ángel has worked for almost 2 decades in the financial services industry, first at Tudor Investment Corporation, and later at the D.E. Shaw Group and Goldman Sachs. Most importantly for our morning, he has been deeply involved in global economic policy debates, most prominently as a senior fellow at the Peterson Institute for International Economics from 2009 to 2016. His book, The Paradox of Risk, was published in 2017. As Director of Studies, I read it cover to cover twice. And with that, yes, I learned that Ángel is smarter than I am, and he's obviously spent a lot more time thinking about risk. And with that, I will turn it over to Ángel to introduce all the other distinguished speakers. Thank you.
Good morning, and it's a real pleasure to be here. It feels a little bit like being back home at the Peterson Institute, and like Mark was saying, it's a little bit like closing a chapter from when I presented my book here with recommendations for central bank how to get out of the low inflation environment, to now presenting this book. This is, as you know, is a volume that has been jointly edited with Bill English from Yale University and Kristin Forbes from MIT. What I'm going to do here is present our summary chapter to basically set the stage for the conversation that will come later in 2 panels. The first one will be chaired by Kristin Forbes, and the second one by Bill English. They will do the respective introductions in turn. So let me just set the stage here. We did the first volume a couple of years ago, summarizing the monetary policy responses of central banks during the COVID era. And we thought that that was it. You know, it was a very successful response, and we wanted to celebrate and document what central banks had done. Then it turned out that part of what happened after that was that inflation surprised to the upside, and central banks had to also react in new and, in some sense, innovative ways to it. And as the slides say, hopefully this is the end of the process. So we had the shock that came from the COVID pandemic, and then we had the reaction on inflation and the reactions by central bank. So what I'm going to do now is walk you a little bit through what happened. And what happened really was that this was a big global surprise. And both words are important. It was global and it was a surprise, and in 2 steps. So what that chart shows is the different evolution of the World Economic Outlook projections starting from January 2021, which is the light solid blue line. Then the April 21, which is the dotted red line, and then subsequent iterations of the WEO forecast all the way to October 2022. On the left, you have advanced economies. On the right, you have emerging markets. if you didn't know anything about what happened, what you can see there is that both charts show similar shapes. So it was common to emerging markets and advanced economies. And there were two stages of the surprise, right? The first wheels in early 2021 show inflation in advanced economies going all the way to 2% over the next couple of years. Then there is the first initial surprise where inflation goes up and then it comes down. And then there is the second surprise where inflation goes up a lot. And then there is the hope that it comes down. Now, why did this happen? Well, obviously we all know this, but I think it's important to remember. There was a massive, large global supply shock. You all remember it was impossible to find a bike at the bike store. It was very difficult to find computers. It was very difficult to find a lot of goods. So you see on the chart on the right, the index of supply chain pressures that the Federal Reserve Bank of New York computes, and you can see the scale of the shock. That's measured in standard deviations. Now, if you look at the chart on the left, that shows the world CPI, calculated from the WIO database. The red line is the median, and the shaded area is the interquartile range. And what is interesting is that there are two moments in the last 3 decades where inflation goes up, and they coincide with supply chain disruptions. You can see the spike in 2008, which sort of coincides with the wiggles in the chart on the right, and then the spike in 2021, which also coincides with the wiggles over there, which is another way of saying over the last 3 or 4 decades, whenever there were demand shocks, inflation was stable. Whenever there were supply shocks, inflation got out of the range. And I think that's an important lesson that we are learning. Now, the second thing that happened, which is the second shock, is that there was a very big and new, which is also important, energy shock. And I'm going to explain why I say new. On the left, you have the evolution of commodity price inflation since the 70s from the database at the World Bank. And you can see there that there have been spikes over the last 40, 50 years. The last one was large and broad. All the lines, basically, are moving together in the spike in 2021-22. What made this instance difference is what you see on the chart on the right. What you have there is the blue line is the evolution of the WTI price, the oil price in the United States. The orange line is the evolution of natural gas prices in Europe. And what I want to see is not really the number, is the order of magnitude, right? That's an index that is 100 in 2007, right? And what you can see is that there is a big difference with respect to the past. There was also an increase in oil prices, if you remember, in 2008, 9, 10, but it doesn't register as very different with respect to gas prices. Why is this relevant? Because gas prices affect electricity prices, and electricity prices go straight into core inflation. And this is the main difference between what happened this time with what happened in previous times. Now, this is the result, right? It was a global shock to both headline and core prices. Now, why do we say it was global? So here is one calculation that we did in our chapter. We compute the percent of the variance of 12-month inflation that is explained by the first principal component. Now, what does a principal component mean? It means the amount of variation that is common. Now, you can see the light blue lines is the period pre-COVID. The dark blue lines is the period post-COVID. On the left is for all the countries, in the middle for advanced economies, on the right for emerging markets. The one message I want you to take from this, the blue line is almost double the size of the light blue line, which means the common component of the evolution of both headline and core double. Now, it could be a common shock, or it could be a lot of idiosyncratic shocks happening at the same time. We favor the interpretation that it was a common shock. Now, this was also amplified by exchange rates, and this is an interesting situation that also relates to the current situation today. If you look on the chart on the left, That's the evolution of the real effective exchange rate in the United States. And that's the one chart that you need to focus on. What happened was a very rapid appreciation of the dollar, basically going from like 97 to around 115, say a 20% appreciation of the dollar in a couple of years. That matters for the United States, but that also means a 20% depreciation of the currencies on the other side of the dollar index. And that generated more inflationary pressures, and if you want, more difficulties for the central bank that had to manage monetary policy on the other side of that. Now, it was global, but as we have learned, all families are unhappy, but they're unhappy in different ways. And this chart shows that. So what we try to show here is the difference in the evolution of inflation across countries by showing the peak inflation rate, both core and headline, across the sample of countries that we have analyzed. And you can see that while Sweden had a peak core inflation around 2% and a peak headline inflation a little bit below 4%, a country like Chile had a peak of core inflation at 10 and headline at 12, or the euro area that had headline inflation peaking at around 10%. So despite the fact that this was a global shock, the country experiences were different. A lot of it has to do with idiosyncrasies of each country. I'll give you another data point, right? The Eurozone is a collection of countries sharing the same monetary policy. The peak of inflation in France was 6%. The peak of inflation in the Baltics was at or above 20%. The difference could be the structure of the electricity market, for example, and how those prices were regulated or not, and how they affected the inflation indices. So different central banks had to deal with this situation also in their idiosyncratic way. Now, the composition of inflation also vary. This comes from the chapter that Olivier Blanchard and Ben Bernanke wrote, and I'm not going to stop in it because Olivier is going to explain this later. I just wanted you to see the color palette of the four charts is different, and that's the only thing that matters. The composition of the shock is different across the different countries. Now, of course, it was a global shock. Of course, it was a global monetary policy response, but the response was also a little bit different across countries. So how do we see that? What you have in this chart is the inflation rate at each country at the time of the first interest rate increase. So the horizontal axis gives you the country, but also the timing according to the year. So the first country to raise rates was Turkey in 2020, a few of them in 2021, and the rest in 2022. But it also shows what the inflation rate was at the time when they started increasing rates. So you can see that Brazil started increasing rates with core inflation around 2.5% and headline inflation around 5%, whereas the Fed started raising rates with core inflation around 6% and headline closer to 8%. There was a difference in strategies, right? That it's explained, and I invite you to read all the chapters of the book if you want to know why this was so different. Now, the summary of what they did is in this slide, right? There were 3 stages of tightening. And I want to say at the outset, we believe the discussion about transitory and permanent is the wrong discussion. And I'll explain why, right? What was the first thing that central banks did? Remember, when this shock happened, rates were at the effective lower bound basically everywhere. By definition, right? The worry at the time was disinflation or even deflation. So the first thing that central banks did was, we need to raise rates very quickly towards a level that is a little bit restrictive. That doesn't mean they were necessarily behind the curve. It meant they had to do a lot of work, right? Especially in an environment where it's possible that RStar, the neutral interest rate, might have increased. And they only realized that along the way. Then after achieving that, they decided to fine-tune the stance of monetary policy to a sufficiently restrictive level. Whatever sufficient means, it's in the eye of the beholder, but that's the decision that they made. Now, there was a debate about what has been described in a speech by Hugh Peel from the Bank of England, whether you want to follow the Table Mountain strategy or the Matterhorn strategy, right? Table Mountain being you raise rates to a level that is sufficiently restrictive and hold. The Matterhorn is you raise rates all the way up, even if it's going to create damage to the economy, and then they will come down as quickly as they went up. Most central banks decided to follow the Table Mountain strategy. And then comes the third step, which may be where we are now, that is, you hold it at that level until you have enough confidence that inflation will return to target. And then you can decide whether to adjust your stance of monetary policy downwards or not. And the question really is, for all these central banks, do you need a weaker labor market to be confident or not? And that also changes across central banks. And again, I invite you to read the chapters for that. So, were central banks the only game in town? No. And this is important. This chart comes from the chapter by Pierre-Olivier Gourinchas and his co-authors from the IMF, where they show that fiscal policy did help. There was a bit of luck in the help, but it did help. The chart on the left shows you the evolution of headline inflation in the euro area. So it's a simulation of what inflation in the euro area was, which is the blue line, and what would have been without the measures that fiscal policy adopted to contain the increase in electricity prices. As you can see, the profile of the blue line seems to be a little bit better than the profile of the red line. However, remember, the electricity shock was also short-lived. So what they do on the right is to show an alternative scenario where energy prices would have stayed high for a much longer period of time. And if that had been the case, then the message changes a little bit. And the profile of the blue line, which is in this case the dotted blue line, is a little bit worse than the profile of the dotted red line. So yes, fiscal policy helped, but we were also lucky. Now, the next question that we ask is obviously, were central banks late in raising rates? You all remember the debates in 2021 about what are they waiting to raise rates, right? So one way to answer this question is to say, well, monetary policy is not just the policy rate. It's whatever the markets do with the expectations and the pricing of interest rates. And so one way to think about this is to look at this chart where we show, in the case of the Fed, the federal funds target rate is the blue line, but the 2-year Treasury yield is the red line. As you can see, it took for the Fed until early 22 to start raising rates. The market was already tightening the stance of monetary policy 6 months before that. The same chart can be drawn for every single central bank in the book. So at the end of the day, were they late? Depends how you define late. But from the point of view of affecting the stance of monetary policy, I don't think the answer is yes. Now, the proof, it's in the pudding, right? So if you look at the evolution of inflation, it does not look like for now, which is the key word, they were late in tightening monetary policy. What you have in this chart is the projections for CPI inflation for advanced economies and emerging markets based on the WIO database up to October 23. We haven't updated this with the WIO that was issued this week. But in all of those cases, what you see is a return to the target or around the target by the end of 25. So the Martian coming to the planet Earth and looking at this chart would say, yeah, there was a shock there, but they managed to handle it sort of properly, right? In terms of returning inflation to target. Now, was there a cost on this? Did inflation expectations dislodge during the process? Well, if you look at the chapter by Roberto Perli and his co-authors, it looks like they didn't that much. What you see in this chart is the market implied expected inflation on the 5-year rate, 5-year forward. And as you can see, it went up, but it only went up to the levels that prevailed during the 2000s. So a question you need to answer is, were the levels in the 2000s about right? were too high, were too low. This is my personal view. I'm not involving here Bill or Kristin. I think this is a very good example of opportunistic reflation. Expectations were too low, we had a shock. Expectations had re-anchored up to the right level. Of course, you can say, well, I didn't really like the scary process, but this is a little bit what happened. Now, has there been any cost? The answer is so far, no. There has been very little damage to labor markets. What we try to show in this chart is the evolution of unemployment rates from pre-pandemic levels to, again, is the October wheel. And you can see that most of those lines slope downwards. So the unemployment rate in most of these countries is lower today after the sharp increase in interest rates than it was in 2019. And in the cases where it's sloping upwards, it's basically at similar levels or at levels that are compatible with full employment. So this is this is one reason to give a good grade to central banks, that they have been able to manage this process with very little damage. And what is really surprising, and if you go back to the discussions in 2021, is how well behaved real wages have been. If you remember the conversations we were having at the beginning of 2021, was this is going to be a wage price spiral, textbook case, 1970s style. And the reality is that not. If you look at the chart on the right, and this is from the chapter that Claire Lombardelli and her team at the OECD did, the red bars is the evolution of real wages. The average, the comparison with the pre-COVID period. And as you can see, most of them are below the zero line. So there has been negative growth in real wages. Of course, there has been growth in nominal wages, but the reality is that real wages haven't really responded much. Of course, you could say, well, they will. And there is the catching up effect that is probably happening and is going to continue to happen. But I don't know if any of you discussing this 2 years ago would have bet that the red bars would be in the negative territory rather than in the positive territory. Of course, then one can say, oh, this is very good. But listen, raising rates by 500 basis points is going to break something. Could have we avoided this? So this comes from the chapter by Claudio Borio, where obviously shows that there have been macro financial risks, that things have broken along the way. Of course, we know that there was the SVB episode where the issues in the UK with the spike in interest rates and others. These are projections made by Claudio and his team at the BIS. The debt service ratio, which is the panel in the middle, is going to go up because the cost of debt is higher. His projections for real house prices are negative. So there is a challenge there, and there will always remain the question of could have this been done differently? But we are where we are. So what are the lessons that we have learned? We have 7 lessons. The first one, forecasting inflation is difficult. Yes, though, but we want to say it because it's very important. When demand and supply are moving, it is very difficult to forecast inflation. For those of you who are following the US discussion, you probably know that the reason the latest CPI number surprised to the upside was due to the cost of auto insurance, which has to do with the increase in the cost of used cars 2 years ago, which had to do with the supply disruptions. I'm giving you an example, a real-life example of how difficult it is to forecast inflation where everything is moving and not just the output gap. So this is something we need to be humble. We need to think about how to forecast inflation, but especially how to talk about the inflation forecast when so many things are moving. Second lesson, don't look through supply shocks. Again, forget about the transitory or permanent. It's the wrong discussion. Is set policy at the right level, right? It always has to be that, but we were a little bit lazy, right, early in 2021, saying this is a supply shock, don't do anything about it. Well, no. If policy is not at the right time, you have to react to it. Third lesson, interest rates are the tool to tighten policy. Central banks have told us that, right? They have put quantitative tightening in the background, passive manner, fully predictable, and they are modulating the stance of policy with interest rates. It seems that it's not the same thing to do QE that to do QT, or to say differently, QT is not the negative of QE. It's a different process. Fourth lesson, you do use forward guidance, but be smart about the design and the use of forward guidance. Explain what it means. The case of the RBA is an interesting example, right, as is discussed in the chapter. They use yield curve control. They use very strict or very hard, if you want, forward guidance. It should have been well explained that the success of policy meant essentially reneging on some of the forward guidance, because at some point you need to start moving rates. So this needs to be explained. Fifth point, embrace fiscal policy. I know this is an heresy for central bankers, but you are not alone, and you are not alone if you don't want to be alone. So there is nothing wrong in cooperating, if that's the word, or at least debating with the rest of economic policy how to best handle the inflationary shocks. Sixth point, beware of the difference between the interest rate and the growth rate and what that might do to political pressures. Right? Be mindful that in this environment, the room for policy mistakes is much less, and how you need to tune your communication. And then seventh, which I think is quite interesting, plan for financial stability if you want to be able to manage price stability. For example, having standing facilities that manage liquidity strengths. When the SVB situation came, it was good that there were liquidity facilities already in place, or that there were liquidity facilities that could easily be taken off the shelf, modified a little bit, and applied. So think about how you can increase your insurance against financial stability so you can be better at managing the price stability challenge. Final points. And in part, this comes from the chapter by Charlie Evans. What have we learned for the future in terms of, do we need to change anything? Our monetary policy framework is robust to a higher RStar. The last time central banks did the review of their framework, the word was RStar is going to be very low. Do we need to change anything if RStar turns out to be higher? Do we need to change anything on the flexible average inflation targeting framework or on the inflation objective? Some people could argue that this is a perfect opportunity of do opportunistic reflation and set the new inflation objective at 2.5% or 3%. Is that right or is that wrong? And then the final point, should the last mile be symmetric in the following sense? A lot of central bankers are now warning the last mile down could be very tough. So we have to be persistent in our tight stance of monetary policy. My reaction to that is, well, that might be the case, but we know that the last mile up during the decade before COVID was quite tough. So be mindful of that. Don't be confident that you can just let inflation go down to 1.75 or 1.5, thinking you are going to be able to raise it back up, because we sort of failed to do that for 10 years pre-COVID. So just keep that in mind. And with that, I will end. And in the interest of time, I think we should move to the first panel. Thank you.
I guess, wait 1 minute, I think, according to their instructions. I'll do a quick introduction. Don't worry, stay close. Okay, welcome everyone. For our first panel today, we have a series of firsts. We have a representative of the group of countries that was the first to identify the risk to inflation and raise interest rates. Then we have a representative of a group of advanced economies, which is also among the first to identify the risks, raise interest rates, and the first country to reduce its balance sheet. And then we have an author of the first comprehensive cross-country analysis of the drivers of inflation. Now, if you couldn't guess who I was referring to as each of those firsts, let me provide a little bit more detail. Our first speaker will be Jonathan Heath, who is currently the Deputy Governor at the Bank of Mexico. Before that, he had a career in academia and in the banking sector. Deputy Governor Heath will discuss how Mexico was at the leading edge of identifying the risks to inflation and raising interest rates. Mexico, along with Brazil and Chile, were well ahead of most other countries in raising interest rates, almost an entire year before the Fed in raising interest rates. And the strategy seems to have been successful. Now, Brazil, Mexico, and Chile have started to lower interest rates. They have not hit inflation as sticky as in some of the other advanced economies. So they followed the FIFO strategy, first in, first out. And we will hear more about that today. Our second speaker will be Dave Ramsden from the Bank of England. He is currently the Deputy Governor of Markets and Banking. Before that, he served as Chief Economist at the UK Treasury. The UK was one of the earlier of the advanced economies to raise interest rates, just edged out by Norway and New Zealand, but still well ahead of many of the neighbors. But where I believe the UK truly stood out was its willingness to combine tightening monetary policy by not just raising interest rates, but also by shrinking its balance sheet. One meeting after its first interest rate hike, the Bank of England started to shrink its balance sheet, started QT. And this was, although now QT has sort of shrunk into the background, is not discussed nearly as often, this was a big move at the time. We didn't know what the effects are. The Bank of England stuck with QT despite some turmoil in the gilt markets around the LDI crisis. And it is one of only 3 central banks around the world that is actively selling bonds to shrink its balance sheet, not just allowing passive unwinding. I believe Deputy Governor Ramsden, though, will not focus on that today. Hopefully we can get to in the Q&A. He will instead focus on the Bank of England's current stance for monetary policy. And then last, but certainly not least, we have Professor Olivier Blanchard. Olivier Blanchard is currently at the Peterson Institute. He was previously the chief economist at the IMF. But where he is probably best known for many of us in this room, or at least for myself, is his many years as a professor in the economics department at MIT. Olivier will present joint work with Ben Bernanke and a team of authors around the world where they have modeled the drivers of inflation in the post-pandemic inflation. So he will put the experience of our first 2 panelists in a broader cross-country context. And this modeling framework is just the best of Olivier, of what we all grew to love in his classroom. It shows his ability to take a whole set of complex models, complex explanations, and boil it down to the core, the fundamental principles, and come up with some tangible, understandable, and insightful results. So with that, no further ado, could I think we will have our panelists speak one at a time at the podium and then jump up, and we will all take some Q&A at the end. So Deputy Governor Heath, the floor is yours.
Sorry. Good afternoon to everybody, or good morning still. Thank you for the invitation, the opportunity to talk about the Mexican experience. First said, I think that definitely the way we viewed this inflation episode from the very beginning, it was global. The pandemic was global, and the response was happened basically in every single country across the world. And I remember at the very beginning, somebody saying, well, yes, in the case of Mexico, this was imported inflation, but I don't see it as imported inflation. It's global inflation, with Mexico being part of the global process, of the global community. Mexico is an extremely open country. We export more than 70% of all Latin American exports comes from Mexico. We export more than all other Latin American countries combined. And so we have a very, very important place in this global environment. We saw inflation started to increase dramatically in the first months of 2021. Our inflation ended 2020 pretty much at our target of 3%. If I remember right, it was like 3.1. And then by March, April, inflation had doubled. It was already at 6%. So, I mean, the response was, let's start raising interest rates and let's start reacting, because we hadn't seen inflation at 6% for quite a long time. And it was definitely something that we had to respond. And I remember discussing many times about why the U.S. still is in that discussion of whether this is a temporary phenomenon or what, and they're just not doing anything, and they're just watching inflation go up, go up, go up. So we started 9 months before the U.S. We had increased our rate by, if I remember, 250 basis points before the U.S. started to react. And we always see our monetary posture in two dimensions, in relative terms and in absolute terms. For us, the relative term is very important because of the relationship and the intertwining that the Mexican economy has with the U.S., which is the interest rate differential between both monetary policy rates. That it had increased from 375 or 350 basis points all the way up to 600 basis point difference, which was a very large gap or increase. And then the U.S. started to increase. At that point, we considered that a 600 basis point differential was more than enough. It was adequate. We wanted to keep it there. However, our absolute posture, our real ex-ante rate, or just taking the nominal policy rate, was still very low. In fact, it was just barely entering into what we considered to be the neutral zone in terms of a neutral posture. So basically, what we did in that next phase was just piggyback on the Federal Reserve, so that our interest rate differential would remain the same, and just make sure that our nominal rate would go up to where we wanted it to be. We reached 11.25 in March of last year, and then that's when we decided that that's adequate enough. That's the terminal rate, and what we wanted to do was to keep our real ex-ante rate somewhere in the neighborhood of 7 to 7.5. At the very beginning, it was below that, but let it increase passively as 12-month expectations kind of edge down, and try and keep it in that range for as long as possible. One thing I think that was very important for us is to understand and to realize that monetary policy effectiveness in Mexico is much less than in many other countries. Obviously, compared to developed countries, but even to our peers to which they were always comparing us to. Everybody mentioned that Mexico, along with maybe, I think, Chile, at one point, maybe one other country, had increased the rate more than anybody else, and that we remain very high, much higher than almost all other countries. But nobody mentions the actual reason why. Financial deepening in Mexico is lower, and because we have a much lower financial deepening, we also have a much lower credit penetration. And this is compared to our peers, Chile, Brazil, Peru, Colombia. So that means that we have to have a higher real rate for longer compared to our peers. And that's why we've remained in the range that we have right now, between 7.5 for a while. What is next? What are we looking at? We did decrease our rate in our last decision by 25 basis points, but we don't really consider that to be the beginning of a downward cycle. We don't see it as the beginning of a normalization process. Our inflation right now came down from 8.7 at its peak to 4.4 in our latest reading. However, it had reached a low of 4.2 in October. So in the last 5 months, we really haven't seen much more progress in terms of headline inflation. Core inflation had been coming down, but now it's kind of getting to a point where it seems to be very sticky, and pretty much in line with, I'd say, most other countries. What we're looking at is services inflation remaining very persistent and not really wanting to go down. Our services component of inflation has remained above 5 now for about 2 years. And what we're looking at is basically kind of a resetting of relative prices. At the beginning, goods inflation was much higher and services lagged behind. And now that goods inflation has been on a very steady downward trend, services is just kind of staying there and kind of setting, making relative prices kind of go back somewhere in the neighborhood of where they were before. This means that we don't expect services inflation to come down, to start showing a downward trend in the very near future, like let's say in the next couple of months. But we do think by the middle of the year, maybe we should start seeing this downward trend. And then once we do see that as a definite downward trend in service inflation, then I think we'll be ready to start a more consistent downward cycle. This cut that we announced in our last decision, we've seen it much more kind of in line as a kind of a fine-tuning approach, where we want to keep the real ex-ante rate between 7 and 7.5, and it was edging up, and it was just about to go through the upper threshold and go above 7.5. So we don't want it to keep on increasing at that pace when inflation definitely has shown some progress, but we definitely don't want to start a real true downward cycle yet, because we still are not satisfied with the results, and we still have a lot of risks. The balance of risks for inflation is definitely still biased on the upside by quite a bit. We still have a very tight labor market. We've had a minimum wage that has increased about 135% accumulated over the last maybe 4 or 5 years. Just this year, it increased 20%. We still have a lot of pressures to deal with. We have a fiscal policy which is completely going against us. The government announced the highest fiscal deficit for 2024 that we've had over the last 30 years, more than double the average of the last 15 years. So obviously, we're trying to step on the brakes, but the government is stepping on the accelerator, and that is definitely not helping us at all to achieve our results. So I think that we are going to definitely remain on hold in the May meeting, without a doubt, regardless of what the U.S. Fed does. And then from June going forward, we're definitely going to be much more data dependent, and it's going to depend more than anything else on whether we meet our projected path for inflation, which we view as our intermediate targets, which means that we want inflation to be at 3.5 by the end of this year. If it is at 3.5 by the end of the year, we will definitely see some cuts in the second half of the year. However, if inflation remains above 4, don't expect us to be very happy about announcing any more cuts. Thank you very much.
Good morning, everyone, and thank you very much indeed to the Peterson Institute for the invitation to participate in today's event, focusing on the CEPR volume, which Ángel did such a great job of introducing. In line with the title of this panel, I want to provide an update on my assessment of the evidence on what has caused the UK's inflation. And this evidence covers the key indicators of inflation, in particular persistence, as well as associated analysis, and what this implies for the extent to which the risks from persistence are receding. Now, throughout much of 2023, I was worried that the UK was an outlier among advanced economies in terms of inflation performance and the degree of persistence. But over the last few months, I've become more confident in the evidence that risks to persistence in domestic inflation pressures are receding, helped by improved inflation dynamics. And I think that leaves the UK looking less of an outlier and more of a laggard in terms of recent inflation performance, and one that is now catching up quickly. Now, let me use my time to set out why I've come to that view. All my comparison slides are with the US and Euro area, in part to keep the presentation manageable. I'll have to run through them pretty quickly in the time available, but the slides and a fuller version of my remarks are now up on the bank's website. So chart 1 here shows how UK inflation has evolved relative to the US and Euro area
since the beginning of 2022. And as the CPR study documents well, all three experienced the first round effects of the global shocks associated with the COVID pandemic and Russia's invasion of Ukraine to varying degrees, which primarily impacted on goods, energy, and food prices. And the Fed, ECB, and bank, along with most other central banks, tightened policy to head off the risk that second-round effects in domestically generated inflation took hold in the context of tight labour markets. The three central banks made historically large and rapid increases in policy rates in successive increments of 50 basis points and more through much of 2022, and indeed into 2023 in the case of the bank and ECB. For the UK, the risks from above target inflation becoming entrenched were considered sufficiently significant that having reduced the pace of policy rate increases to 25 basis points last March and May, the MPC stepped up the pace again with a 50 basis point hike last June. The MPC's assessment of the risks emphasised three key indicators of persistence: labour market tightness, private sector wages, and services inflation. And trends in these indicators have also played an important part in the MPC's decision to hold bank rate at 5.25% since last August, alongside communications which have stressed the need for monetary policy to remain restrictive for an extended period of time in order to slow the economy and bring inflation sustainably back to the 2% target, the Table Mountain approach. US and Euro area inflation fell sharply through 2023, driven primarily by falling energy prices, with their contribution to inflation turning negative in the spring and summer of last year, respectively, as Chart 3 illustrates. And the unwinding of first-round effects is also increasingly evident in the easing in core goods and food price inflation, which are directly and indirectly impacted by energy prices. By last September, headline inflation had fallen sharply to 3.4% in the US, 4.3% in the euro area, but only 6.7% in the UK, leaving the UK clearly standing out. The UK's divergence at that point was broad-based, but also in part reflected the timing of UK energy interventions relative to those across Europe. Second-round effects are most evident in services inflation, which is relatively labour-intensive. Direct labour costs are responsible for around a half of services costs in the UK and more domestically orientated. In the UK, services inflation was 6.9% as recently as last September, contributing to around a half of total CPI inflation at that time. Now, based on its assessment of a range of evidence, including the three key indicators of persistence, the MPC judged that second-round effects in domestic prices and wages were expected to take longer to unwind than they did to emerge. In other words, they were likely to be asymmetrical. Furthermore, the risk to inflation, both from persistence and from energy prices following the emerging conflict in the Middle East, were judged to be skewed to the upside. In the November 2023 MPR forecast shown in the table, modal and mean CPI inflation did not return to the 2% target until around the start of 2026. In the more recent February 2024 MPR, in view of the improving trends in the key persistence indicators and in headline inflation, the MPC forecast that on the central case, CPI inflation would fall to 3.6% in 24 Q1 and to 2% in 2024 Q2. The latest release published this Wednesday showed CPI inflation fell to 3.5% in Q1 and 3.2% in March. And given what we already know about domestic energy price setting in April, we can be increasingly confident that inflation will fall close to the 2% target in April. Now, the upcoming MPC round will be an opportunity to revisit all of our forecast judgments. When thinking about current UK inflation dynamics and the interaction between first and second round effects, I found it useful to distinguish 4 steps in the inflation expectations, wages nexus, and I'm going to run through them quickly. Step 1 is characterized by the feed-through of dissipating external inflationary pressures on headline inflation. As Chart 4 shows, and Chart 4 is just the UK bit of the chart of the previous chart 3. This shows first-round effects from external inflationary pressures, primarily stemming from energy prices, were particularly prominent in driving the increase in UK energy, food, and core goods prices. In step 2 of the nexus, shown in chart 5 here, falls in headline inflation have lowered inflation expectations. As headline inflation has fallen back materially since November 2023, household and business medium-term measures of inflation expectations have come back in line with historical averages. Market measures of medium-term inflation expectations continue to remain more elevated, though off their peaks. But more recently, I've started to focus more on shorter-term expectations, given the closer correspondence to headline inflation, and importantly, their significance in our understanding of wage dynamics. In the bank's most recent inflation attitude survey, and that's shown in the turquoise line here, year-ahead expectations for inflation fell to 3%, their lowest level for over 2 years. In step 3, the easing in inflation expectations is a key driver in weakening pay growth. Annual private sector regular pay growth has fallen from just over 8% in 2023 Q3 to 6% in February 24. Now, drawing firm conclusions on the evidence from the labour market is hindered in the UK by the issues with the official LFS data on labour market quantities, and separately also by the volatility in the official average weekly earnings series. So the MPC and other forecasters have had to put more reliance on a wider range of labour market evidence and alternative models of pay growth. Notwithstanding these uncertainties, and against the backdrop of a technical recession in GDP in the second half of 2023, the UK labour market has clearly continued to loosen. This is apparent from a range of indicators, including official data and surveys, and it's clearly evident in the decline in the vacancies to unemployment ratio, the MPC's preferred measure of labour market tightness. Chart 8 illustrates that from early in 2023, earnings rose by significantly more than could be explained by our 3 main models, shown by the swathe here. In response, the MPC made a judgment to build in more persistence in the wage forecast, a judgment that got progressively larger, peaking in the November 2023 MPR projections. In terms of short-term trends, our indicator-based models of pay growth suggest that underlying regular pay growth has already slowed to around 5% from a peak of around 8%. The MPC's forecast for annual earnings growth is expected to fall further from its current level of 6% as headline inflation and inflation expectations continue to fall against the backdrop of still weak activity and ongoing loosening in the labour market. Now, in step 4 of the nexus, weaker pay growth has started to feed into weaker services inflation, which further broadens out the disinflationary process. This chart shows successive short-term forecasts for CPI inflation. These are really built bottom up from the components relatively mechanically. Now, and the forecasts from last November had services inflation staying around 7% until the end of 2023, a similar path as in August, then projected to fall to 6.4% by March 2024. In the latest data, services inflation, and you can see that again in the turquoise line, continued to fall in March to 6%, slightly above the short-term forecast underpinning the February MPR forecast. Now, chart 10 provides a decomposition of one measure of underlying services inflation that the MPC looks like. It suggests that the fall from the peak last summer reflected moderating pay growth, but also weaker producer prices for services. The short-term projections are consistent with the February MPR and illustrate that large base effects from last year will drop out in 2024 Q2. The rationale for focusing on an assessment of services inflation as an indication of persistence has been that services prices more reflected domestic inflationary pressures, in large part from the labour market, and that these pressures are inherently more slow-moving or sticky, particularly when labour markets are tight. A recent BIS paper supports a similar line of argument based on cross-country comparisons. But there's also analytical evidence that services inflation has been determined to a greater extent by the energy prices shock. For example, by estimating effect using the most recent data and exploiting the cross-country differences in energy prices, my former MPC colleague Jan Vliega finds energy prices to be more important in driving services. Now, this does not mean that the MPC's assessment that service inflation reflects stronger and more persistent domestic inflationary pressures doesn't apply. As chart 11 here shows, the UK is still clearly an outlier when comparing 12-month services inflation rates with the equivalent rates in the US and Euro area. But from my perspective, it does imply that while services inflation continues to be more homegrown, we should place more weight on the likelihood that a greater part of recent services inflation will dissipate more quickly and so lead to less persistence as the energy price shock unwinds. The chart here shows that the UK's 3-month annualised run rate for services inflation has recently converged on the equivalent rates for the US and Euro area, and I expect this to be increasingly the case for the 12-month rates. I think it's also notable that the inflation dynamics implied by the nexus are playing out against a backdrop of continuing weak activity in the UK, reflecting the impact on demand of restrictive monetary policy, as well as the constraining influence of weak supply. UK supply growth has been characterised by both weak productivity growth and low levels of participation. UK GDP grew by 0.1% in February after 0.3% growth in January, implying an end to the technical recession at the end of last year. But GDP is still 0.1% lower than it was 2 years ago in 2022 Q1, when energy prices surged after Russia's invasion of Ukraine. Over the same period, US GDP has grown by a robust 4.3%. To conclude, the UK now looks like less of an outlier in terms of recent inflation performance and more of a laggard and one that is catching up fast. Similar disinflationary effects to those which started earlier in the US and Euro area are coming through, leading to a pronounced reduction in UK inflation. UK CPI inflation in March was below US CPI inflation, and the April data is very likely to show the UK in converging and in line with the Euro area. Now, there are going to be bumps in the disinflation process from one month to the next due to base effects and other one-off factors. But a more material distinction is that the disinflation process in the US is taking place against the backdrop of a stronger economy, particularly on the demand side, and is already proving to be less smooth. Now, at the MPC's last meeting in March, I was one of 8 members who voted to hold bank rate at 5.25%. Over the last few months, I've become more confident in the evidence that risks to persistence in domestic inflation pressures are receding, helped by improved inflation dynamics. As we set out in our March minutes, there's a range of views among the MPC on these risks. And as I've explained today, developments in the nexus of inflation expectations and wages, including at higher frequencies, suggest the restrictive stance of policy and the more symmetric unwinding of second-round effects are reducing the more persistent components of inflation, such as services inflation. My assessment is that the balance of domestic risks to the outlook for UK inflation is now tilted to the downside compared to the MPC's February 2024 forecast, with a scenario where inflation stays close to the 2% target over the whole forecast period, at least as likely as the February 2024 forecast, which showed inflation rising above target to close to 3% by 2025 Q1. The MPC will have to consider collectively the degree of restrictiveness of policy at each upcoming meeting to ensure inflation returns sustainably to the 2% target. I'm going to continue to take a watchful and responsive approach to my policy decisions, as I've tried to do throughout this period of unprecedented structural shocks. Watchful in terms of assessing the evidence as it accumulates, and responsive in terms of the stance of monetary policy warranted by that evidence. Thank you very much.
Very good. The start of this project is the paper that I did with Ben Bernanke last year on the United States that many of you have seen. at the end, when we presented the paper, a large number of central banks came to us and said, why don't we do the same thing? And rather than having 10 separate projects, we decided to actually make it one project, which I coordinated. And we finished the work in late 23, and then cleaned it up until very recently. So what is in the volume is kind of a teaser of the ultimate results. And the full paper is now being edited, and the replication team is at work. And if you know anything about Peterson, editing and replication are intense and take time. So the paper should come out something like a month from now. But you're going to get the essence of what we did. The list of countries which decided to join is given here, and you have a lot of Euro countries, and there is an interesting aspect to it, which I'm not going to talk about, which is we have the Euro view of things, what was done by the ECB team, and the view of a number of members. And one of the questions is whether it coincides, and not always is the answer. And then we have other important countries. We have the US. In the case of the US, we didn't ask the Fed to do it. We did it ourselves because we had done it in the previous paper. But we have Canada, we have Japan, and we have the UK. What I want to give you a sense of the mall. The mall is academically very non-fashionable. It is basically an undergraduate mall type of stuff that you would teach undergrads and they would understand. And we thought this was the right vehicle, at least to discuss with policymakers what was going on and to organize the data. So I just want to go through it. To some of you, it's going to sound like the 1970s, but I don't think that makes it wrong. The starting, four equations, a wage equation. So wage inflation, we thought of as depending on the state of the labor market. There's an interesting discussion, which actually is an interesting one from the point of view of what we're discussing, which is what variable you use. Traditionally, it was unemployment. I think that many of us think that vacancy to unemployment ratios are a better variable, and we used that in all the countries. So labor market, short-run inflation expectations, 1 year, thinking that when you set wages, you actually want to know what prices will do next year. And then a term called, which we call catch-up, or which is called real wage gap, which basically says, if in the past there was unexpected inflation and therefore your real wage went down, you may want to recover what you have lost. Quite apart from your expectations of the future, you just want it back. And we thought all three factors might play. That gave the wage equation. The price equation said, well, basically it's a markup pricing equation. So price inflation depends on wage inflation, productivity growth. This is the standard stuff. And changes in relative prices, which are the relative price shocks that we have been talking about. So we had three of them in the empirical work. We had energy, obviously. We have food, and I think it's a very interesting aspect of this episode is how much the price of food has played a role, and whether we fully understand what happened there. But it clearly moved a lot, more so in Europe, even more so in Japan, for example, than elsewhere. And then a variable trying to capture these supply chain distortions. The price spikes which come from the fact that you can't get a car, and so on. The interesting point here is that these price spikes are going to show up in core. That relates to what Ángel was saying before, which is typically we take food and energy out and then we have core because we think that's fine. That's not where the relative price shocks are. But in this case, I think many of the shocks actually went into core. So we don't do a distinction between headline and core. We just write a price equation with these variables. So this gives you price inflation in the last two equations, which also play an important role, like inflation expectation equations. And here we decided not to go over rational expectations route, but just use expectations measures that were available in the literature. We didn't use the Michigan survey. We used expectations from markets or from forecasters. The long run expectation is about, typically depends on the country, but 5 to 10 years where people think inflation will go back to. And we made it, we allowed it to be a function of just actual inflation plus lags. I'm going to talk about lags in a minute. And then the short run inflation expectations we thought would depend on the long run expectations and on actual inflation. And we just estimated those. The feedback is that the short run expected inflation feeds back to the wage equation, which leads high expected inflation, leads workers to obtain higher wages. So I think it's as conventional as can be, but it can be taken to the data. In terms of methodology, we decided to have what I would call a quasi-VAR approach, which is not to play with the lag structure, have a very generous lag structure, and just let the data talk. This leads to more noise because when you tighten the lag structure, you get tighter results. But we thought this was the way to go. So this is the background, and this is kind of a interpretative framework which we used and that was used in the project by the banks. In nearly all cases, the central banks just use exactly the same model. There are some differences in the data used by necessity. Just a remark on this, I think this was actually touched on by the previous speaker, the wage series. And they can be very different, and particularly different in the current recent context. Are you going to use compensation per hour, or are you going to use compensation per worker? When you have schemes which have partial employment, it makes a big difference. Are you going to use new wage settlements or old ones? And for some countries, it makes a difference. And I think, again, there are things to dig in and find out more. Okay, that was for the methodology and to tell you. So now I'm going to tell you the story as it comes out of these 11 country studies. And it's a very, I mean, I think, again, the previous speaker said it's a global inflation episode, and it's true. I mean, basically, we found a lot of commonality in the description of what happened in different countries. There are some differences, which I'll come back to, but the story is amazingly common. So the first part of the story is that if you look quarter to quarter, and we use quarterly data, most of the movement, the high frequency movement, comes from relative price shocks. Be it food, be it energy, or being price spikes. Price spikes, we should have said this, we proxied through measures of shortages. You don't observe price spikes per se, but if there's a shortage, you can expect that the price will go up. And two results absolutely dominate quarter to quarter, and the effect of each shock is large and not persistent at all. And that shows you what we call the impulse responses, impulse response functions for the US and the Euro to an energy shock, a food shock, and a shortage shock. And you can see big effect initially, and then it basically goes to zero within 2 quarters or 3 quarters. That's the fundamental difference with the 70s, right? There's just no persistence. And there could have been persistence because expectations of inflation would react very strongly and therefore lead to more wage inflation. There could be indexation, but there is now very little. Only one country, Belgium, had indexation. And the result is basically that these shocks come and then they go. They don't have long-run effects or persistent effects. So in that sense, team transitory, remember that discussion at the beginning, team transitory and team permanent? So team transitory was right in the sense that the shocks came and they went. I think it was wrong in thinking there would be just a few shocks and we'd be done. Basically what happened was a series of shocks for close to 2.5 years, but the idea is still there. So the short run completely dominated by price shocks. Yeah, just one more thing in relation to something which was said before. When you actually look at the composition of the price shocks, there are differences. You know, energy prices being more important for Europe and for the US for reasons we all understand, proximity to Ukraine. Food shocks being much more important and puzzlingly so in Japan. Most of the action in Japan is actually food shocks, and it comes partly from the depreciation of the yen and the fact that food is largely imported. So different composition, but price shocks in general. Okay, so this is a graph that clearly you cannot see or at least interpret, but it's just, this is the same graph as before, just for all the countries to show you that, yeah, it's true for all countries, basically. Okay, the second part, and as important, is that behind the scene, the labor market first softened during COVID, large increases in unemployment or in less than full employment, and then tightened. If we use the V over U variable, it is higher at the end of our sample, which is the middle of 23, second quarter, than it was pre-COVID. So basically a tightening of the labor market. Stronger in some countries, and in one country I think it's basically zero, is Japan. But otherwise, clearly tightening, leading to tighter labor markets today. So this had kind of the old conventional Phillips curve effect, which is you have a tight labor market, it puts some pressure on wage inflation, and then the wage inflation leads to more inflation, which leads to expectations, which leads to more wage inflation, and so on. So this is kind of the old wage Phillips curve type story. And it was playing. You get here the impulse response functions of inflation to a one-time permanent increase in V over U. So this is a model which conceptually and analytically has the natural rate property. So there's only one V over U which is consistent, absent shocks, with stable inflation. So when you increase this, when you increase V over U, then the model predicts that wage inflation will increase over time, forever, as long as you're above natural value of V over U. We find this, but we find that the effect is fairly weak. There is some pressure, but it's not very strong. And that's low frequency. And what this means is that as inflation was happening, this was not quite visible. It was there. Wage growth was increasing slowly, but not very much. Now, the issue is, as the price shocks have gone away or are going away, then what appears is that. And that's what central banks are basically fighting today. Once the price shocks are gone, you have the increase in wage growth due to a tight labor market, the adjustment of expectations. And this is what explains why inflation is still a bit high in most countries. This, again, is just to show you the impulse response for all the countries. And as you can see, it's not, I wish it looked nicer for some countries, but we didn't play with the lags. Basically, it goes up, right? If you have a tight labor market, it keeps putting pressure on wage growth. And that's what happened. So having done this, we put everything together and we did a historical decomposition. I'm going to show it to you only, I think, for 2 countries. It would be too much to absorb if I showed you the 11. So let me just spend a minute. I mean, the temptation is to go through these graphs, which are complex ones, too fast. So let me just go step by step. So what we did first, we took them all, and we said, suppose there had been no shocks. So V over U would have remained at its value at the end of 2019. No energy shock, no food shock. Okay. So what would have happened is given by the gray bars. So basically, this is an implicit statement as where the economies were relative to the natural rate then. But you can see it's fairly flat. It looks like in the US, we are probably a bit tight, a bit under the natural rate of unemployment. But that's the case for the US and the euro. And then we took each shock. We said, let's take the series of energy shocks, leave all of them, all the others aside, and just feed it in the mole and look at the contribution of that shock to the history of inflation. We did this for each of the shocks, and we did this for all the residuals of the equations. And the sum of them by construction is going to give you the actual inflation rate. So that's one way of thinking about what was behind. And I think there are two striking aspects of these graphs, or 2.5 actually. The first one is the importance quarter to quarter of the energy, the food, and the shortage shocks, right? The yellow ones are shortages, the dark blue is energy, and the light blue is food. And you can see that from quarter to quarter, this is what moves inflation, right? By the end, you see that the shocks become either smaller or actually reverse sign, and you get, for example, the price of energy to play on the downside. Now, the interesting thing is the red, which I think looks more brown here, but the red part. The red part is the contribution of the tight labor market. So initially it's negative because the labor market was loose, but then it becomes tighter. And for the US, you see it's never very big, and that reflects the fact that the wage Phillips curve is fairly flat. You don't get a lot of action in wage inflation from a tight labor market or a loose labor market. But you can see that what happens when the shocks are gone is that we're slightly above. We have this basically 1% value at the end. Now, this is not today, right? This is at the end of our sample, would be roughly the same today. And that says, well, now the price shocks are gone, but we have wage growth, which is too high. How do we get back to target? And that's a discussion about the last mile. Our paper was not about that. We all understand that if productivity growth is not great or remains what it was rather than what it is now, it is going to be hard to actually eliminate this 1%. If we're lucky and productivity growth is strong and wage growth happens to be weak for other reasons, then we'll get there easily, but we don't know. But anyway, this small red part is now what matters. The rest is more or less gone. The half conclusion is a comparison between the two, which is if you have good glasses, you can probably see some red part to the Eurozone, but it's very, very small. Another way of saying this is that in the Eurozone or the Euro area, most of the inflation was imported. Maybe you don't like the word imported, maybe it was global, but it was not due to the labor market, it was due, right? So this is an example in which, there's nothing exceptional happening in the labor market, but you get a lot of inflation. And then it goes away. Now again, that's better news at the end, because indeed, if you don't have a problem with the labor market, then presumably you can hope to go back to normal without having to tighten. And that's more of the situation of the Fed. Now, I think I didn't show you other historical decompositions, but in retrospect, I should have done it for Japan. So Japan would look a bit different in the sense that the gray zone is much smaller. The underlying inflation is much lower, as we know. It's too low relative to their target. But more importantly, there is just no red. Absolutely no red. And that comes from the fact that the labor market in Japan is exactly the same as it was at the end of 2019. So this is kind of a typical, the extreme case of a country which suffered from stuff from outside and then went up, went down. And so this, this is a conference about monetary policy. So I should say two things. The first thing is that we don't talk about monetary policy because our model is not a general equilibrium model. We basically take V over U as given. Now, what's behind V over U or what's behind the labor market is fiscal policy, monetary policy, and so on, but we don't go there. So clearly somebody more ambitious would do that. So we don't have anything to say, but I still have something to say based on on what I showed you, which is, suppose, take the case of Japan. No, basically, your long-run expectations are fairly anchored, and then you get these large shocks, and the labor market is not doing anything particular. Why on earth do you increase the interest rate, right? Traditionally, the story, you increase the interest rate because it's going to slow down the economy, and that's going to be good for wage inflation, price inflation, and so on. But in this case, it's all stuff that you really have no control upon, right? So why is it that you increase the rate? I mean, we got a very good argumentation for the case of Mexico, but my sense is you do it not at all for the mechanical reasons, because actually you don't want to slow down the economy. I mean, there's no reason to do it, but you do it to keep credibility of your target of long-run expectations not being anchored. So the question is then, how should monetary policy think about episodes like this? By how much do you increase the interest rate to keep credibility? Maybe you're very credible, and then you don't need to do anything. Or maybe you're not very credible, and then you need to do something. But the something is what? Is it keeping the real rate the same? Is it having a higher real rate? Is it just increasing a bit to show that you're not asleep? I do not know, but I think that's a genuine issue. And the reason I insist on this is that I think we're going to see more episodes like that. The geopolitics being what it is, I think it's quite likely that we'll get a Strait of Hormuz episode at some point, and we'll get an Iran-Israel war and so on. So it seems to me that we're going to get these large price shocks, and then what does monetary policy do? Does it kind of say, well, it's going to come, go, don't want to do anything, I don't want to kill the economy, there's no point. Or I increase rates just to show that I'm tough. And I mean, from an intellectual point of view and a practical point of view, I think that's a really interesting issue. Let me stop here. Thank you.
There are some kind of cross-country differences, but the global shocks were clearly the primary determinant of the big moves of inflation. And behind that was an escalation of violence, which drove up energy and commodity and food prices. We could be on the verge of a similar situation, an escalation of violence in the Middle East, leading to a spike in energy prices. So how would each of you respond, or what would you recommend as the response of central banks? Olivier, as you said, shocks come and then they go. Can we be as sanguine this time around? But you also highlighted the role of slack in the labor market. And in many countries, the labor market is now tighter, so it's not the same situation. Also, you highlighted the role of credibility, why shocks can come and go. But now that we have recently hit a period of high inflation, do central banks need to be more cautious about counting on their credibility? So I was wondering if we could maybe start with you, Olivier, and then we'll go in reverse order, Dave, and then Jonathan. So Olivier, you could give the broad overview, and then Dave and Jonathan, you can talk more about the specific examples in your country of how you would think about a shock to energy prices.
So I would do two things. I would watch two things. I would watch the output gap, and I would watch long-run inflation expectations. If, for example, as in the case of Japan, there is no output gap coming, then I would watch long-run expectations as a hawk. And I would, as soon as they moved, I would basically move a rate. And we don't know, how long-run expectations will react to the rate, but I would basically move it and see whether it quiets markets, and if it doesn't, I would move it more. But it seems to me that relative to a terror war. I would basically have the output gap for the usual reasons. I think that's still there. But I would put a whole lot of emphasis on just killing any deviation from long-run expectations, from target.
Let me ask one follow-up, and I'll give these two a bit more time to think about their answers. You barely mentioned the exchange rate in your comments. And now the dollar is quite a bit stronger, so that could also aggravate some of these other inflationary pressures. Is that something that should be in there in the thought process?
Sorry, I didn't get the question. I'm sorry.
You barely mentioned the exchange rate in your comments. And for some countries, the exchange rate is an important determinant of inflation, at least longer term than energy prices, even if not as persistent as the labor market.
I've not thought about it.
I have not been able to stump you in ages.
So I think Olivier's framing in terms of the output gap and medium longer term inflation expectations is absolutely right. I mean, we face this issue somewhat as the Middle East crisis unfolded last autumn, and at that point we decided that, you know, obviously there were risks compared to what our conditioning assumptions on energy prices, conditioning assumptions for our forecasts, there were risks relative to those. So using the machinery we currently have, and obviously we've just had the incredibly important review from Ben Bernanke into our forecasting, but using our machinery as we have, we built a skew into our fan chart, so saw that, you know, there was the potential for the mean to be above the mode in our forecasts, and that in turn framed our policy. If you like, that's a way of indicating our reaction function. But just to build on Olivier's point, I think I would also, you know, I would bring it back to what it was incredibly helpful piece of work that Olivier and Ben sort of corralled amongst the central banks, as it were, in terms of trying to come up with a common framework. And I think the emphasis that comes out of that on the role of the kind of your labour market context and conditions matters. So, I mean, looking at the UK at the moment, where I think, I mean, if you'd asked me the question a year ago, I was worried that medium-term inflation expectations were going to become de-anchored. That was the time when we were raising rates, you know, and as I said in my presentation, not only were rates going up incrementally, 25 basis points, but we then went back to putting them up 50 because we were getting nervous about, or certainly I was, that was motivating some of my voting. But where medium-term inflation expectations are now and where short-term inflation expectations are coming down, against the backdrop of, as I try to present, you know, using the VU ratio, what I think is a more obvious easing in the labour market than perhaps we'd been seeing through the second half of last year. I'd be looking at all of that in the round to frame my policy response. But I think the other point I'd make is I think we are in an age of greater incidence of shocks. So we are going to be facing this world more often as or continuously as policymakers.
Jonathan, how would you respond? Unfortunately, we don't have the breakout from Olivier's analysis for Mexico.
Oh, I think we have actually two experiences in terms of energy shocks in Mexico, and both were very different and actually interesting. Towards the end of 2016, we had our inflation pretty much in line with where our target is, and the government decided to adjust the price of gasoline by, I think it was like just a one-off, by something like 25%. The response, first of all, the response in the population was riots and looting, and it was a massive demonstrations and everything reaction to that. But inflation more than doubled just in 2017, finishing the year, if I remember, 6.4% or something like that. And even though there was a monetary policy response to that, and we're showing that we were obviously preoccupied, it came down on its own once that wore off. And by towards the end of 2018, we were more or less back to where we needed to be. There's this one single price, and it caused a tremendous inflation bout. And the other one is in 2021, and it was precisely because of the reaction in the population to that huge energy shock that we had self-induced in 2017. In 2021, the president promised to make sure that gasoline prices did not increase at all. So when prices were increasing all over the world, it was a heavy fiscal cost, but we had gasoline prices subsidized. So gasoline prices did not go up. But then when inflation started coming down in most countries, which was induced by the decrease in energy prices, we didn't have that benefit. And so our inflation didn't come down maybe as quick as in others. But we did in both cases respond with a very important monetary policy, monetary increase in our rates. And I think that that's basically kind of the experience from what we draw on and what we would do.
Open it up to the floor now. Why don't we start at the first table? Phil, and then Beat. Why don't we take 2 questions, and then we'll come back to the panel, and you can repeat.
Thanks. Phil Aldrich at Bloomberg. It's one for Dave. The UK market path for rates is being pulled up by what's happening in the US. And I think the communications from the bank here have been that it doesn't seem to think that it does seem to think that there should be some divergence potentially in policy between the UK and the US. I just wondered if this is going to become a communication problem for you guys.
Per Siegenthaler from Rockos. A little bit of a similar question here, since we are at the IMF meetings and everybody, and we've had obviously this another big repricing of the US. So everybody is talking about decoupling, divergence, how much these things can really differ from each other. So I'm just curious, what you see in terms of spillovers if, let's say, the Fed indeed did not cut rates this year. I mean, Mexico is obviously a bit closer and maybe more direct implications, but I would imagine also for the UK there are some spillovers. So just curious, what you see they would be and how much they matter or not. Thank you.
So thank you. Those are very complementary questions. So if each of you could address this combined, what is the importance of spillovers? For example, Mexico was striking how Mexico moved right about at the same time as Brazil and Chile. So and they were ahead of most other central banks. So there did seem to be a regional effect. Is it similar shocks, or do the spillovers between these countries matter? And then, of course, the big spillover everyone has their eye on right now is the US. The US is now on hold for an extended period of time. How will that affect each of your strategies? We, of course, know that the strategy for every central bank is to do what is in the interest of their inflation target and their domestic economy. But how important is it for you if the US is on hold for an extended period of time? And then, Olivier, what can we tell from your models on this? Can the other countries simply behave differently? Can they minimize the spillovers?
In the case of Mexico, we definitely look and follow the Fed, and whatever the Fed does, it's obviously very important for us. But actually, we don't really look further south. We don't really give much weight at all to what other countries like Chile, Colombia, Peru do. They just don't really, they're just not big enough, or they're just not important enough. But the Fed is definitely extremely important. If the Fed does not cut in the short term, it's not going to really make that much difference, because we think we have a very strong, very high interest rate differential that we can use and play with. But eventually, there's no doubt about it, we would never be able to go against or have a really important cut if the Fed doesn't move at all. So I mean, we have a correlation, and we need to have a correlation with what the Fed does, but it's definitely far from a perfect correlation.
So, I mean, although you kind of, the way you framed the central banker mantra, Kristin, I mean, I think in the UK, we will do what makes sense in terms of our mandate, and that is a 2% inflation target, a symmetric target. As you kindly pointed out in your introduction, we did start to raise official rates at the end of 2021 before the Fed, and we were among the first countries to start unwinding our balance sheet. So, although, as you rightly emphasise, that's more in the background and maybe for another conference, but I'd be happy to contribute to that conference. I think look, to Phil's point around, but I mean, and it's linked to Beat's point, I guess. But obviously, we will take account in our assessment of the drivers of inflation of what's happening to the exchange rate in terms of what it means for inflationary pressures. But we're an inflation targeter through and through. I mean, on Phil's point, we condition our forecasts. Again, this is something that Ben Bernanke's not only been reviewing, but raised a number of issues with. We condition our forecasts on the market path for rates. I say this at every, or pretty much every MPC press conference I attend. Markets are entitled to take their position. There has been, the UK curve has moved up in recent weeks and months. Now, that might be because the market is more worried about UK persistence. As I've tried to set out in my presentation, I'm actually becoming somewhat less worried around the risks of persistence. But I'm not going to comment on what that should imply for the curve. We just need to try and be, I think, or indeed for, in the way we present our forecasts and the way we talk about them, which I think is your point about comms, we will just have to, when we get to the next forecast round, it's actually starting on Monday, and then presenting it publicly, think how we communicate those differences. But as I tried to say at the end of my presentation, I mean, I think some of the fundamentals in terms of US growth dynamics are quite different at the moment from the UK's. And I think the UK's inflation dynamics, why I said that we've been a laggard, it's taken a while for the various effects to come through. But we're increasingly confident in our forecasts that inflation is going to be back at target from April onwards. I think the question is, as I was trying to set out in my presentation, for how long?
Good. Now I think questions that were asked and Kristin's addition raise a very important issue. First, I think of central banks as trying to get R to be equal to RStar. That's kind of how I think about it. And I'm struck by the fact that the RStars, short-run RStars, not the ones in 10 years, are very, very different in different countries, right? In the US, it's clear that private demand is strong. It's clear that there is fiscal responsibility. And all this means very strong aggregate demand. And this means a substantial RStar. I think the best guess is 2%. Something like that, right? Europe is different. Private demand is weak. We are going to do fiscal consolidation, maybe too much of it, but we're going to do it. And so I think our star is much lower. The R hasn't quite been adjusted yet, but it will soon. And probably the relevant R star for Europe is probably 0, something like this. And Japan, basically is back to where it was in 2019 with a negative R star, despite a very large fiscal deficit, a very strong fiscal push, and extremely weak private demand. So again, I think the central bank should just try to achieve those R stars, which means that they are going to be quite different. And this clearly has implications for the things that you think about, namely exchange rate. I think that this really suggests that we're going to get a strong dollar and a weak euro and a weaker yen. That's the way it is. But I would never tell the ECB to try to emulate. I always thought this discussion was stupid, that the ECB should try to stay close, or was trying to stay close to the US. They should each do what they need to do. If the exchange rate goes crazy, then it becomes different. But that's where I am.
And would you say the latest movements in the yen-dollar count as going crazy?
If I knew enough about Canada, I would give you an answer.
Any last questions? Yes.
From the OECD. Just one comment or question, but it's mostly for Olivier. So we talked about supply shocks, but we actually didn't talk about that much of a sectoral differences. In the case of COVID, of course, there's a goods sectors and services sector, and there was a large unbalanced demands for goods sectors that then run into supply constraints. So even in an aggregate model, if you consider the supply shocks, you don't get this type of steepening of the Phillips curves just with the supply shocks. You need a multi-sector model, at least with two sectors, with goods and services. IMF has a working paper also. Ivan Werning worked on this. So I was wondering how in the case of a model that Olivier mentioned, how do you see this as a more of an anomaly, or we should really focus on more of a sectoral dimension going forward also for monetary policy?
Before I hand it over to you, I'll also point out in the chapter Ángel summarized, we do talk some about the importance of looking at sectoral analysis in the future when you get supply shocks, that the sectoral effects were important and not captured in our standard models, and that's where there is more progress to be made. Hand it over to you.
So this episode has made me rethink the way I think about inflation. I used to be of a traditional mind that strong demand leads to low unemployment, which leads to wage inflation, which leads to price inflation. But that was focusing on the effect of strong demand on the labor market. And I think, there is strong demand on the goods market as well. I mean, the firms not only have to be able to find the labor, but have to have the production capacity. And I think that in kind of mundane recessions, firms have enough of a buffer that they can do this without increasing prices given marginal cost. But I think this is a warning that if there is really a very large increase in demand relative to supply, then marginal cost increases. The kind of price spikes we saw, I think, is episode specific. Maybe there are going to be other episodes like this, but it was really very different from the usual. What I'm struck by in the quantitative exercise that we did, which I showed you, is how the shortage variable still plays a role today. We're open to the idea that during COVID, you couldn't get this or that, but we're in 24. And the yellow part of the historical decomposition, which was shortages, is still playing a role. So clearly these supply disruptions can have very, very large effects. Again, it takes very special events for them to be so important, but I would say now I would be much more careful about looking at pressure, not just in the labor market, but pressure in the goods market as well. And I think that's relevant for what comes next.
Would you like to jump in there, Dave? I see you nodding.
Well, no, really. No, I think, it comes back to why I think the volume that's been published and why this event is so important. It goes back to actually Angel's first lesson, how you talk about inflation when so much is moving around. And I agree with Olivier that, the pandemic was an extraordinary shock. And so most, the other shocks that we've been talking about, although they have supply consequences, I mean, it's interesting where the extent to which they'll actually affect economic structures, I think, is open to discussion. But I mean, we're grappling in the UK. I mean, it's more on the labour market side than on the goods side, but goods market side. But we still have this issue where participation is still lower than it was pre-COVID. We seem to be having some longer-term scarring in terms of the impact on our workforce and their ability to participate in the labour market. So, I mean, again, that's a more traditional labour market feature, but it just shows you that many more things are moving around than we've been used to.
Thank you very much to all of you. We will now shift directly to our final panel, which will tackle the impact of all of this on financial markets and take a more forward-looking angle of what this all means for central bank mandates and frameworks in the future. Thank you.
I think we're going to get started, so please make your way back. All right. Welcome, everybody, to our second panel. In terms of logistics, it will look a lot like the first. I'm Bill English. I'm going to start us off with brief introductions for our three panelists. Then each panelist will speak for 10 or 15 minutes or so. Then I'm going to ask them to comment on the others' remarks if they choose, and then we'll open things up for questions from the floor. The title today is Monetary Policy Responses to the Post-Pandemic Inflation, What Happened and Lessons Learned. So our first panel was mostly about what happened, and the second panel is going to focus more on the lessons learned. So we'll begin with lessons from financial markets. The COVID shock and the subsequent very large, very rapid adjustments in monetary policy were something of a stress test for financial markets and policy implementation. And we're fortunate to have with us Roberto Perli, the manager of the System Open Market Account, to discuss these issues. Roberto received his PhD from NYU. He was a professor at the University of Pennsylvania. Then he was a colleague of mine in the Division of Monetary Affairs at the board. Then he went to, this guy can't keep a job. He went to the private sector, most notably as a founder of Cornerstone Macro, and last year returned to the Federal Reserve System as the SOMA manager. Second, we're going to consider the implications of the pandemic, the policy response, and the high inflation for central bank mandates and central bank organization and governance. Happily, on our panel, we have Carolyn Wilkins, who knows more about these issues than just about anybody else, because she was on the committee that conducted an external review of the Reserve Bank of Australia that reported in last year. Carolyn did her graduate work at the University of Western Ontario and then went to work for the Canadian government, moved to the Bank of Canada in 2001, and rose to serve as senior deputy governor from 2014 to 2020. She joined the Bank of England's Financial Policy Committee in 2021, and she's also a senior research scholar at the Griswold Center for Economic Policy Studies at Princeton. Finally, we're going to look further to the future and consider the lessons from the post-pandemic experience for central banks' monetary policy frameworks. In particular, both the Federal Reserve and the ECB have promised framework reviews in 2025, and other central banks, no doubt, will also be reacting to the recent experience. So we're fortunate to have Charles Evans, until last year, the President and Chief Executive Officer of the Federal Reserve Bank of Chicago, on our panel. He played a significant role in the development of the Fed's earlier frameworks, and so is well placed to think about the implications of the recent history for those frameworks. Charlie got his doctorate from Carnegie Mellon, and after spending some time in academia, moved to the Chicago Fed, where he served as Director of Research before becoming President in 2007. So welcome to the panelists. Thanks very much for participating today. And Roberto, you're up.
Thank you, Bill, and good morning, everybody. I guess, yes, it is still morning. So thank you for inviting me to this discussion here. I think the volume that Kristin, Bill, and Ángel put together, I think is a terrific volume. So Eric Lesur, who is right here, my co-author, and I are certainly very happy to have participated in that volume. So before I start, of course, I don't want to forget, I have to tell you that the views that were expressed from now on are my own and not necessarily those of the Federal Reserve System or the Federal Reserve Bank of New York. I think I inverted the order, but concept is the same. Look, I think this volume is great. And I think it is, as far as I know, the first, or at the very least one of the very first, to look in a systematic, comprehensive way at what happened, how the wave of inflation happened, how it affected policy, how it affected markets, and a lot of other things. So that's clearly an advantage, and I'm pretty sure that future research, there will be a lot of future research, and will draw on this volume a lot. So that's the advantage. Of course, being early sometimes comes with disadvantages as well. The disadvantage in this case is that the inflation wave that hit in earlier in the previous years has receded. Yes, has not receded completely. In particular, as you know, inflation is still above the Federal Reserve target, and for that reason alone, and many other reasons, I don't pretend to draw any definitive conclusions in this discussion. But nonetheless, I'll make a few points that have to do with how suddenly the inflation wave hit, have to do with the strength of the policy response, the impact on markets, the resiliency of markets, and I will conclude by saying a few words on the policy implementation framework, which has worked very well. So this next slide, I think everybody managed to advance the slide without any help, but apparently I cannot. In any case, I was, got to be a secret. Okay, so it's my, every time I do some presentation, something happens, but that's okay. Sorry, apologies to the Peterson Institute here for breaking the system. But look, I think, let me say, obviously, inflation came as a surprise. It was a surprise to a lot of people, policymakers for sure, but it came as a surprise to the markets as well. And I had a beautiful chart here that I wanted to show you the extent to which markets actually missed the coming of the inflation wave. For about a year and a half, markets were behind, because the market kept saying, yes, inflation, yes, there is inflation, but it will subside soon. And it took, there it is. For a second, we had the chart, but well, I had it, you didn't. It's okay. So the markets were its policymakers were not the only ones to be. Thank you. There we go. Thank you for that. Policymakers were not the only ones. Markets were behind the curve. We used to call, Bill is familiar with this, the hairy caterpillar chart to be applied to the federal funds rate expectation, but the concept is the same, that the actual inflation in dark is the caterpillar, and the hair are what markets expect inflation to do at any given point in time. And of course, again, between early 2021 and mid-late 2022, markets were off, right? So inflation came as a surprise. It's fair to say. Why was it so surprising? Because it is many reasons, but of course the inflation result, as Angel said, I think was a result of many confluent factors. Certainly once in a lifetime, hopefully, pandemic, a demand surge induced by pent-up demand after the shutdown was lifted, and of course the role of the war in Ukraine as well. So these factors were hard to anticipate ex ante, but also were, even after they became known, they were it was hard to assess what effect they would have, because we hadn't seen something similar in a long time. So models, analysis in the past were not particularly trained to this type of situation. So policy response on the part of the Fed, probably other central banks as well, some sooner, some later, but it didn't come exactly immediately. Why? Because, well, first of all, the Fed has a dual mandate. There is a there was need to pay attention to the second side, to the other half of the mandate, unemployment, but also because, look, there was a lot of uncertainty as the markets, this chart proves, a lot of uncertainty about the extent, duration of inflation, and also there was a risk management aspect. Say, well, we need to balance the two mandates. But and of course, compounding all this was the fact that for many years before, inflation had been at or below target, right? So there was this sense that inflation had been weak for a long time. But eventually, it became clear that inflation was a bigger problem that it may have seemed initially. And also became clear that the other side of the mandate was doing just fine. The recovery became self-sustaining, the labor market improved very rapidly. And when all this became clear, I think the positive response happened, and happened fairly quickly. It happened in essentially two ways. It happens via the balance sheet, via interest rates. Of course, the FOMC has made it clear that it still considers the interest rates as the primary tool for monetary policy response. But the policy response, again, started with communication about the balance sheet, about tapering of QE, and then ending QE, and then talk about QT, and eventual implementation of QT, and with a beginning of rate hikes in the middle of that. I think, from a balance sheet perspective, this sequence of steps had pretty noticeable effect on financial markets, on interest rates, in particular term premiums between September 2021 and the final announcement of QT in May. Term premiums responded pretty significantly to this crescendo of communications. So that was the first impact that the balance sheet had. But after that, there was also the rates, or the rate response, the main response. And this chart shows you that the rate response started gradually, 25 basis points in March, but then it picked up speed fairly quickly. And, of course, we had four consecutive 75 basis points rate hikes between June and November of 2022. And then as inflation began receding, progressively the pace of hikes diminished, and of course FOMC has remained on hold since July of last year. But this chart, I think, shows fairly well the combination of policy response, the rates, but also the balance sheet shrinking at the same time. And those lines, they're all fairly close to each other, but in order, the first one, line A, marks the start of QE tapering, the end of QE just a short few months later, immediately after liftoff, line C, and then the start of the balance sheet shrinking process, line D, at half speed, and then full speed on line E, which is still continuing to this day. So pretty significant policy response, and you see it from this chart. So leave the balance sheet aside for a second. Just look at the rates. The rate cycle, the hiking cycle, was by far the fastest in recent memory, the post-Volcker era, right? So, and up until this cycle, people, especially in the market, in the private sector, looked at the 1994-95 cycle as the epitome of the aggressive, even disruptive policy cycle. Well, this time around, the Federal Reserve went about twice the speed. So very aggressive policy response. And of course, whenever you have a tightening cycle of this magnitude, you can expect that markets will move, and they certainly did. Prices did. We saw some disruptions, fairly modestly. I have in mind the spring of last year, kind of a mix of fast consequence of fast rate hikes, and probably subpar risk management on the part of some institutions. But be it as it may, Fed tightened aggressively and markets moved, and I'll start by looking at Treasury yields here. So I show the 3-month, 2 years, and 10-year rates. So yield moved up a lot, as you would expect, right? Because the policy rate moved up a lot and moved up fast. Yields moved up, and the yield curve inverted. I'll say something more about the inversion in a minute here, but just for now, I'll just point out that the curve has inverted about 2 years ago, and still inverted to this day. So it's a long period of inversion of the yield curve. So by all measures, definitely a sharp increase in interest rates. You see the brief pause around March of last year when the banking sector stress hit, and markets started thinking, well, maybe this is the end of the cycle or interruption of the cycle. There could be rate cuts. That did not happen, thanks to the fact that the episode was contained, thanks in turn in part probably to the swift and decisive policy response. So these are here are nominal yields. I think is very instructive to look at what inflation compensation did, a component of nominal yields. So what I show you here is 2 lines. So the blue line is short-term inflation expectation. In particular, I show you the 1-year inflation swap rate, and that was extremely volatile and moved up a lot, and moved pretty much in sync with actual inflation. So in other words, inflation happened in the short term, and markets realized, yes, inflation is probably going to stay here for a year or so. But the other line is the longer term inflation expectations, and they were extremely stable. Sorry, I should say inflation compensation. They were extremely stable. So that's good. That's first. Maybe that's the first sign that inflation expectations were stable as well in the longer term. So how do we disentangle inflation compensation from inflation expectations? Well, inflation compensation equals inflation expectations plus risk premiums, liquidity premiums, and other stuff. So we need to isolate inflation expectation. To do that, the only way I know is to look at models. And I think Ángel conveniently showed us a chart earlier, because I don't have it here, but if you look at those models and try to isolate inflation compensation and basically try to look at the green line, the inflation expectations component of the green line, you see that it has increased a little bit back to levels of the mid-late 2000s. And if you consider the fact that TIPS are indexed to CPI, whereas the Fed has a target based on PCE, and you try to make the adjustment, well, we're not very far from 2%. In other words, inflation expectations have remained very well anchored around the mandate, which I think says something about the accumulated credibility, the credibility that the Fed has accumulated over the past many years. Let me say something about liquidity and volatility. So the chart at the left here, panel 7, shows you implied volatilities. So rates moved up sharply. There's a lot of uncertainty as to how much they will continue to go up or how much they will stay up. Therefore, implied volatility increased to levels that we had not seen since the financial crisis, right? So pretty significant increase in implied volatilities. There is an established, I think, relationship between volatility and liquidity. And so the chart at the right shows you that market liquidity deteriorated, treasury market liquidity deteriorated over this period, but it deteriorated no more, and maybe actually a little bit less than what is implied by the increase in volatility. In other words, the important message here, what I'm trying to say, is that the treasury market remained remained functional. Market functioning was preserved. Liquidity diminished, yes, but market functioning was preserved. What does it mean? It means that trades could be done, even in size, of course, at a higher price, but also means that the market response to the news flows was in the direction you would have expected given the news. In other words, it was not a situation like we saw, for example, in March 2020, where no matter what kind of news we're getting, treasury yields were going up. But March 2020 mostly got bad news, but treasury yields were going up, right? So clear example of dysfunctional market. Nothing like that happened here. Somewhat less liquidity, yes. Dysfunctionality, no. So obviously, talk about treasury market here. Let me say a few words about other markets. But I show you here a compendium of all those markets, the index of financial conditions. I show you the Goldman Sachs index of financial conditions because it's what market participants look at most. Could have showed you the board, Federal Reserve Board index, fairly similar concept. It's an index aimed at assessing the impact of financial conditions on the economy, on growth, on GDP growth, on economic activity in general. There are other financial conditions indexes that are more aimed at market functioning, and those don't show a lot of action, precisely because market functioning remain good. So that's why I'm showing you this index, but the financial conditions, bottom line, tighten, restrained economic activities, or at least economic activity forecasts, much more than in other circumstances. Of course, we saw equity prices declining initially. Why? Because rates were going up, so lower valuations, but also remember the yield curve. Inverted, the equity market participants, or market participants in general, chose to interpret that as a sign of imminent or forthcoming recession. Luckily, after 2 years, that hasn't happened yet. So the market chose to interpret it that way. When it became clear that maybe there is at least a possibility that the inversion of the curve was simply a consequence of the fact that the Fed had to raise rates above a neutral level. As a result of that, it would also have to come back to neutral eventually. So when that realization sank in, equity market performance started to become again solid. It was pretty good last year, continues to remain positive this year. But also, we saw obviously impact of higher rates in mortgage markets, much higher mortgage rates for new mortgages. Of course, very few people refinanced their mortgages, which kind of means that if you look at the weighted average coupon on outstanding mortgages, it moved up, yes, but very little. In other words, the impact of the tightening on the housing sector was very strong on housing activity, but because a lot of people retained their mortgages, the impact on cost was much less, and probably we haven't seen yet the full impact of that. So probably slow transmission of monetary policy in that sense. Of course, something similar can be said about the corporate sectors, corporate bonds. Rates went up, but there wasn't an imminent need to refinance a lot of existing bonds, and therefore limited impact there as well. In any case, financial conditions tightened, but I would say markets remained very, very resilient throughout this period. And I think that this testifies to a lot of things, including, I guess, risk management practices. Thank you, Bill. And I'm just about to conclude with just a few words on the monetary policy implementation framework, which I don't know any other ways of describing than saying that it worked very well. As you can see here, the blue line is the federal funds rate relative to the target range, which is the gray area, and the administered rates, the green and the brown areas. Federal funds rate has been very stable, very little volatility. Of course, this is a consequence of there being a lot of reserves in the system. We're still operating. We have been operating, probably still are operating, on an abundant reserve regime, but the monetary policy framework has worked really well. It has been subject to a number of tests, including the very fast increase in the administered rates in the target range, but also different tests, right? So the banking stress test of March of last year, the run-up to the debt limit, with the Treasury General account diminishing to very low level, and then the rapid rebuild of the Treasury General account after June of last year. All this were pretty eventful times in money market. The implementation framework worked really well. I'll stop here, but thank you for this, and hopefully I made it roughly on time.
Well, let me start by thanking the Peterson Institute for the invitation. It's just a great opportunity to talk about a review of a central bank at a time when they're under the microscope, not just in Australia, but everywhere else. And I hope that by the time I'm done this, we'll see just how much correlation there is between the lessons that we drew from the review and the lessons that Ángel was talking about this morning. And so I just need to say that this is in my capacity as the reviewer at the RBA and not in my capacity as a member of the Financial Policy Committee at the Bank of England. So just a little bit about the review. Our report was tabled last year, and in fact, it's engendered already a number of changes at the RBA, and also a whole host of changes or proposed changes to the RBA Act, which are in the process of going through Parliament right now. And so this is a very live topic. The review was commissioned to be independent by the Treasury. And so I think that's pretty important because the RBA was very cooperative, but they weren't in charge. And we certainly were not given instructions about what we were supposed to get. And the we here are the three people that did the review. There was Gordon de Brouwer, there was René Fry McKibben, who's actually sitting right over there, and then me. And you know, what's really interesting is you might have thought when it was commissioned in July 2022 that it would have been the COVID thing that was the motivator. But in fact, it wasn't. The motivation for the RBA review came much before that. And in fact, the concern was really that inflation had been too low. And given that the RBA has a flexible inflation target with a full employment mandate, that involves some, discussions about the trade-offs and whether they were made in the right way. And I think just because of the fact that the review, there hadn't been a review of the RBA for a very long time, and certainly not one since they adopted inflation targeting in 1993, the mandate was astonishingly broad. And you can see it here. There were the monetary policy goals and governance that included the interactions with fiscal and macroprudential policy. That in itself is huge. There was performance in meeting the goals, including the use of the policy tools, not just over the COVID period, but over the 30-year history. And then there was a piece on RBA culture and the management. I'm going to focus on the first two objectives just because of time, but I wouldn't want that to make it look like I didn't think the other one was important. So, I think what was absolutely clear from the get-go was confirmed by all the people that we talked to was that the RBA is an institution that is highly respected, not just domestically, but internationally. And that respect was earned. Much like other central banks over that long period, they had in their inflation target largely met it. And you can see from the chart on the right here that, of course, headline inflation is pretty volatile, but if you look at their trimmed mean kind of core measure, it was much less. And if you do the arithmetic, you can see that over most of the period, that inflation came in pretty much at the midpoint of their band, which is 2.5%. So their band's 2 to 3, and it's a fat line. It's not meant to be a specific target, but they certainly were pretty much in the middle. And that's something that's very similar to other central banks that are inflation targeters. Where the trouble started to happen in terms of the public perception and the academic perceptions was in the 2016 to 2019 period where inflation was under target. So over that period, it averaged around 1.7. Since the midpoint of their thick point of 2 to 3 is 2.5, that's quite an undershoot for quite a while. And the communications around that weren't very clear in the sense that there might have been some sense that it was for financial stability reasons to lean against house price growth, which was quite strong at the time. But then there was not a lot of explanation about how those trade-offs were being made vis-a-vis the full employment mandate. It looks astonishingly small. I mean, you're squinting to see that undershoot in the red circle, I bet. just because it was followed by such a large overshoot. In Australia, the headline peaked at 7.8, not that much off headline in other countries, but certainly in real time a cause for concern. And the assessments are very similar in terms of where it came from. Obviously, supply shocks and supply chain disruptions were a big part of that. But that didn't change the fact that in real time, people are very concerned about the inflation. They're feeling it no matter where it comes from. And so a way to approach just the more recent period to give a sense of, at least for that period, where did our recommendations come from? I think it's useful to think about the assessment of the response in 3 phases. And our assessment wasn't to say, did they do the right thing or did they do the wrong thing, but are there any lessons to be learned in those different phases? And so the first one was just the kind of initial response that was pretty similar to other central banks, where it was kind of whatever it takes. Let's all hands on deck, fiscal policy, monetary policy. And so they lowered their cash rate. They, instead of implementing QE, they implemented yield curve control, which was basically a yield target at the 3-year level. They paired it with some forward guidance that was state dependent. And the state was based on forecast inflation and full employment. And so, and when you look at that period, kind of up to when they took new decisions in September of that same year, it looked like it did what you would have hoped it would do, which was stabilize the economy, stabilize markets, and create the conditions that would not only help them meet their inflation target and their full employment objective, but also created an environment in which fiscal policy could do what it needed to do and finance that in well-behaved markets. I think where the divergence in views about the success here come starting in October of that year, where they basically doubled down. And there was, of course, a lot of uncertainty at that time. We knew that, maybe there might be a vaccine, but not quite. We knew there were new waves, and there were still shutdowns. It was just so hard to tell what was needed. But clearly, they extended the yield target by another year. They changed their forward guidance to be time-based and also based on actual inflation outcomes, not forecast inflation outcomes. So we want to see inflation in the whites of the eyes. And there was a lot of uncertainty. So the point that we're trying to make, and that we commissioned some studies, so Anastasio Orphanis did one, there was enough there, though, to think that you could have had a better debate than we saw in the board documents as they were making the decisions. So the comment here is really about the degree to which they were talking about upside risk to inflation, upside risk to the outlook at a time when it felt like that was a reasonable expectation. And then, of course, they went through the taming inflation phase, as everybody else did. I think what distinguishes the RBA, and I'll get that, is really the exit from QE is quite different from the exit from a yield target. And it's fair to say that the exit from the yield target was pretty disruptive. Hindsight is a beautiful thing because it's 2020, but it's also very humbling. And so let's just keep that in mind when we say, like other central banks, those feather charts of changes in forecasts look pretty similar for the RBA. Lots of large and correlated errors that were persistent errors. Quite similar to what we saw in the report we saw this morning, but also Ben Bernanke's report on the Bank of England. And the reasons are obvious. We've discussed them. I think the one thing that hasn't really been said is the objective function of the central banks. And some people might say it was fighting the last war. I don't know, but clearly there was a desire to really avoid or insure against the downside risk to inflation because of the possibility about how hard it would be to get back up and getting back into the trap that we thought we were in before. And it was also very hard, and particularly hard, to modify forward guidance in the RBA's case because it was tied to the yield target. And so I think that created a bit of stickiness in their approach. I talked about the disorderly exit. It was basically forced on the RBA because of the way that the yields actually moved in markets. And so they faced a difficult choice. Either we don't defend the target or we give it all we've got to defend it. We know what they ultimately decided. But in the board documents and in the discussion, there was very little about what alternative exit strategies would be. The exit strategy was that it would just expire. And so, now, of course, they also had introduced a government bond purchase program, and there has been some consideration about whether or not that actually had any effect that was worth the substantial cost. Again, those cost-benefit analysis weren't really discussed in the board taking the decisions as well. There was unclear governance, and it feels like that's kind of a technical, bureaucratic comment to make. But when you're an unelected official that has considerable delegated power, it's quite important to be clear about how decisions were made, and that governance needs to be watertight. And in this case, there were some questions in the sense that not only did the board not get as much information as they might have, they didn't ask for it, but also they weren't consulted for some clear decisions that, for example, having a time-based element in yield in the forward guidance, or extending the yield target, or dropping the yield target. Those were not brought to the board, those decisions, which is rather awkward ex post. So it leads us to, just checking the time to make sure I'm okay. Yep. It leads us to some recommendations that shouldn't be that surprising and that are the subject of some of these legislative changes. And the first one is just, if you have a board of directors like they do at the RBA, that's got a lot of really, really successful people, ton of titans of business, but not necessarily experts in monetary policy, well, maybe you should change that. And so, not surprisingly, we asked them to constitute an expert monetary policy board that had a clear set of skills and knowledge that were related to monetary policy and macroeconomics that would help provide that challenge function. We also wanted them to have support of the staff in a way, and time in a way that they didn't now, to actually input into the kind of analysis that was done. We wanted a separate governance board that did the administrative stuff, because their board today does both, and we thought that was a distraction from monetary policy. The second thing was just clarifying the monetary policy framework. It should have been clear, but in fact, there was a lot of confusion about what was the role of full employment in this particular framework. And so it was really more about not changing the framework, but saying, communicate how you're making those trade-offs. What do you think full employment is? When do you think you're going to get back? And that sort of thing. Clearly, we know that there are other potential frameworks out there. We thought that it would be best to study those in a 5-year review, and like other central banks do, like the Bank of Canada, and think about things like nominal GDP targeting or a higher inflation target, and take into account that, in fact, we might have more supply shocks than we had in the past. More transparency on the decision-making, and that would include actually publishing unattributed votes of the board members, having press conferences, which the RBA did not typically do on a regular basis. We wanted them to legislate a financial stability role and make it clear that financial stability and monetary policy maybe they're related, but the tools should be different. They should coordinate with APRA, which is their prudential regulator, on macroprudential tools that will reduce the reliance on monetary policy to lean against financial imbalances. And then finally, just, if we're saying you should look at upside risk and downside risk, you need tools to do that. And so we thought that they should use more regular use of cost-benefit scenarios, stress scenarios, and to do that, they needed to have better models. Not only just to do the baseline forecast, but to do meaningful scenarios. And that would take, I think Ben Bernanke has made exactly the same point for the Bank of England. That takes data, that takes resources, and that takes expertise and a lot of time. And so given that, it felt for Australia that relying a little more on the academic community and integrating their research would be useful. So the last thing I'd say is that I don't think we're even close to being done in terms of understanding what the final full cost of benefits of this episode are. And I think that's partly because we haven't gotten past that last mile in terms of getting inflation back. I think the other reason is we don't know for sure all the macro-financial costs and risks, as Claudio Barrio has put out, because they're still unfolding right now. And so I think if we had a priority on the assessment, it would be on the tools and how effective they actually were given the financial costs that were ultimately incurred. And the last thing I'll say is we really need to understand better the optimal policy mix between fiscal policy and monetary policy in particular, because there are trade-offs about which policy instrument you use and the relative effectiveness of each.
Okay, well, thanks for including me in this terrific conference. Let me congratulate the organizers and the editors for putting together a second terrific volume, apparently, and it will be a reference for quite a long time period, and hopefully there will be no need for a third volume. I picked up on that. Let me, before I lose my lead, just say that my task was to think about long-run frameworks. I focused on the Federal Reserve's upcoming 5-year review, and my take on this is that the 2020 long-run framework review that Jay Powell commissioned the framework itself continues to be a sturdy framework for the Federal Reserve. I think it's been a sensible evolution of strategies over the last 20 years for the Federal Reserve, and I think it will be able to withstand strong objective scrutiny during the review process. But there will be a lot of scrutiny indeed. Okay, now I retired from the Federal Reserve in January of 2023, and since then I've realized that I can say things a bit differently than I did before. Same messages, but perhaps a little less nuance. And so one message that I've shared with people is that, in 2022, as inflation was extremely high, the Fed was embarrassed that inflation rose so high. Olivier threw another charge out there. My heart skipped when you said team transitory, but that's another example of the embarrassment that I think central bankers sort of experienced as inflation rose so quickly. During the time of their September 2020 implementation of flexible average inflation targeting, they were actually trying to be extremely accommodative. February 2022, the CPI rose to 7.9%. That's the report that just sort of focused my attention on how far things had gone. Now, I think embarrassment is actually a positive aspect of humility. If you're asking for a central bank to be humble and display humility, I think the fact that you display embarrassment at some level is an example of that. And Chair Jay Powell and the FOMC repositioned strongly monetary policy beginning, they lifted off in March of 22, but by June of 2022, they really took charge of tightening and seeking a restrictive stance of monetary policy. As the upcoming Fed framework review approaches later this year, I think this high inflation experience and embarrassment is going to be hanging over the Fed's head. And I think it's going to be important to remain objective and dispassionate in assessing the learnings and implications for the next 2025 framework. If you'd attended other conferences on this subject, it would not be hard to hear commentaries along the lines of, let's just rip up the last long run framework and start from scratch and think about this completely differently. I think that would be a bad thing to do, but objective scrutiny is very important. Now, to think about the next framework review, I think it's reasonable to remember how this came about. The evolution from Greenspan to what I'll refer to as Bernanke-Yellen to Powell-Clarida, I think was a natural one. And, and in the context of the dual mandate for maximum employment and price stability. Remember, Alan Greenspan didn't prefer an explicit inflation objective. He wanted a qualitative inflation objective. And he, if pressed, would sort of say price stability is when businesses and households really aren't thinking about inflation in their financial planning. Everything is perfectly fine, and they don't really get excited about that. Ben Bernanke came in and had the idea that being explicit was best practice for a central bank, would pay dividends in terms of anchoring the inflation expectations, with Janet Yellen, convinced the committee to adopt a 2% inflation objective. Within this framework, mainstream central banking practices were preserved, and you would raise the interest rate when you need to be restrictive, and you would lower it when you needed to be accommodative. And so they were just explicit about the inflation objective. So very much along the lines of the Greenspan tradition, but by being explicit. Now that Jay Powell comes in as chair and thinks that it's good hygiene to review the framework, plus we've learned a bunch of things about how difficult it is, this inflation targeting is. And so with Vice Chair Rich Clarida, convinced the committee to pursue 2% inflation on average over time, recognized that the effective lower bound was a risk for the attainment of the dual mandate objectives, and that overshooting 2% actually can have some benefits in terms of, moderately, can have some benefits in terms of good monetary policy. So back to the 2025 framework review, in light of the recent experience, I think the learnings are pretty clear. Anchored inflation expectations are a big deal. Olivier, with Ben in his paper, mentions the very important role of anchored inflation expectations. I think that's right. We experienced substantial increase in relative prices, energy, food, housing. Inflation went up a tremendous amount, and then it started to come down, and it could have really become embedded if inflationary expectations weren't anchored, but it seems like they were, so that's very important. We realized that raising the funds rate worked to contain inflationary pressures, so we avoided many of the second round effects in the US and around the world, it seems. Again, it's possible to implement restrictive monetary policies within the current long run framework. And we have to remember that providing accommodative policies can be difficult when you're at the effective lower bound. It became very clear that the Fed's implementation of flexible average inflation targeting in September 2020 in the FOMC statement contained some challenges in terms of what happens if things go off the rails and inflation starts up very quickly. I think of this as everyone was expecting inflation to come in through the front door via Phillips curve types of effects, and so you were trying to maintain accommodative monetary policies to keep the economy going, and you would expect a gentle rise in inflation with a flat Phillips curve, but in fact relative prices increases were really tremendous, and so that led to substantial inflation. Chris Waller and Jane Ehrig have written about this in their nice chapter on the US Fed policy here, and they also mentioned some thoughts about how this could have been addressed differently. I view this as tactics of monetary policy are going to be very important to think through in terms of the review process, and less so strategic aspects. And also, I think the effective lower bound risk will continue to be tangible. We don't know what the future RStar is going to be. Relative price volatility is uncertain, and so maintaining flexibility is going to be very important. Okay, with this background in mind, some thoughts for the upcoming framework review. I think a lot follows from an inflation objective of 2%. With 2%, the effective lower bound risk, is tangible unless there's a big change in the structure of the U.S. economy. The setting at 2%, crystallizes ELB risk. If you had a different inflation objective, it would be different. Your likelihood of using quantitative easing also goes up if you're going to the effective lower bound. So whenever I run into somebody who says they don't like quantitative easing, can't you get away from that? I think you have to remember that the choice of the inflation objective is really important for that. So if you were to change upwards the inflation objective, maybe you wouldn't have to do QE as much. Why 2? I think the Fed would be well served, and all central banks, by making an affirmative case for why 2% is the right inflation objective. Chair Powell said not too long ago in an interview, I think it was 60 Minutes, where he said, we've been well served by a 2% inflation objective. I agree. An explicit inflation objective has been very important. It's crystallized inflation expectations. Whether or not 2 itself is the right number continues to be a matter of debate. So I think an affirmative case for 2 would be a very productive thing. We shouldn't just blame New Zealand for how we got to 2% 40 years ago. Of course, another learning has been reinforcing the idea that the public dislikes inflation intensely. Now, I'm a monetary economist by training. Ben McCallum was my dissertation chair, and I'm not an industrial organization economist, a microeconomist. So I think, a careful assessment here is really important. Households, businesses, they dislike high inflation, but they dislike high and volatile inflation. Relative price variability is really a big deal. So when gas prices go up a lot, food prices go up, housing goes up a lot, that's really important. In the face of large relative price shocks, should other prices be squeezed lower to average 2%? If you're a monetary economist and you're really thinking this is monetary, are you supposed to set a restrictive stance of the monetary policy so that other prices fall so that you can still get close enough to 2%, so you say you're living by your mandate, as opposed to that 7.9% where you kind of go, oh, this is not right at all. I think having an appreciation for that's important. I think it's kind of a losing battle, because anytime gas prices go up, the public's going to be unhappy with central bankers. This is probably part of the bargain that was made for Fed independence, which is you're independent, that means we get to complain about everything that you do or everything that goes wrong. So that comes with the territory. If you don't like it, you should stop playing that game. But I mean, it's a different question to ask, is steady 3% inflation very costly? Would steady 3% inflation lead to more volatile inflation? I'm unaware of theory that links the level of inflation with variability in inflation, except when policy authorities mess up and it becomes really a monetary phenomenon in that regard. Next, living with 2% as your inflation objective. I think more work there is important. Enhancing the symmetry of the inflation objective is good, but it only goes so far. I do like the viewpoint where, if you could bring yourself to sort of say inflation should be above but close to 2%, to limit the idea that 2% is actually a ceiling, because I worry that when you say 2% is your inflation objective, everybody gets very nervous when inflation goes above 2%, and you sort of back off very quickly. Whereas if you had an attitude where you acknowledge it can be above 2%, but we're going to keep it close, that could be helpful. Lastly, maybe inflation undershooting 2 isn't really a big deal. I struggle here because I had a lot of conversations with my colleagues over the years when we were under 2% and we should be going to 2%, but you could have a forecast that you're going to be at 2% in a year. So, what's the big deal? Or the, 1 3/4 isn't so bad. If we were ever above 2 by 2 1/4, I'd feel the same way, to which I'd always go, I don't know, we'll have to see if we ever get there. And then we got to 7. So we haven't really run that experiment yet. It might be fine as long as inflation expectations aren't reduced, but if that's the case, I think you should say it explicitly. Maybe a range for inflation would be a tactic for an underrunning strategy where it's okay to be below 2. I think these are some important issues that are going to come up, whether there's a range, whether it's a point target, what it is. But my bottom line is I think the 2020 long-run strategy remains a sound and sturdy one, adjusting the tactics for any future flexible average inflation targeting episodes is likely an improvement opportunity. Everybody's aware of that. That's on the list to be looking at. So thanks very much.
So we're running a little long, so we have only a little time. But I thought it would be good to take at least a couple of questions from the floor. So I'll ask you, please give your name and affiliation, and please also be sure you actually have a question. So questions, please.
Rich Miller at Bloomberg. Thank you very much for having this conference. Olivier earlier mentioned the possibility of RStar being higher. And I'm wondering, especially in the United States, I think he said, I'm wondering how all of you are thinking, especially Charlie, thinking about that. And if RStar is indeed higher, is the zero lower bound as much of a problem as we thought before? And how should that sort of affect the framework discussions that the Fed and others are going to have? Thank you.
We could take another and group them if there is another question.
Patrick Honan in Peterson. So we had a 20% cumulative inflation in different countries over the past 3 years. It was a sort of surprise inflation, and it affected debt, value of nominal debt. Was that a good thing, or was it a bad thing?
Okay. Yes. I believe the second question was asking about the implications of a surprise inflation for debt, right? Reduced real debt burdens, presumably. And you could view that as a good thing or as a bad redistribution of wealth. Not quite on our topics necessarily, but an interesting question. Charlie, do you want to start us off? Go in reverse order.
Sure. What if RStar is higher? I think that would be a good thing. I mean, if RStar was higher, you'd expect the neutral level of the funds rate, policy rate would be higher. You'd have more capacity to, cut rates if you actually needed it. Presumably, higher RStar, well, I tend to think of it as being related to trend growth. And so if it was a case that trend growth was higher than what we're looking at right now, that would be good. That could be through higher productivity, higher labor. Now, if you're thinking it's due to premia coming to do with debt issuance and things like that, so that's going to induce more challenges and all of that. 20% cumulative debt and inflation and debt, I don't know. I never would have touched that as a central banker. I don't think I should touch it now. I will simply mention that it's probably the case, Chris Sims, I think, others. It's like, what's the optimal price level when you've got a lot of debt? Sometimes the answer is to have a big surprising increase in the price level. That's a market kind of thing. No central bank could engineer that, presumably, or would choose to, but you're going to do a lot of issues there.
Yeah, the only thing I would add on the RStar is even if it is higher, I mean, mechanically, the probability of hitting the zero lower bound would mechanically, all else being equal, be lower, but we don't know what the size of the shocks are going to be in the future. And so if we think we're going to have a more volatile world because of the geopolitical risks or climate change or whatever forces, then it's not clear to me that a small increase in the real rate really solves your zero lower bound problem. On the debt one's hard. Just when you think about the value of inflating your way out, it's a repeated game. And so you would think at one point it would show up in risk premiums.
I agree. with both with both of you, actually. Yes, look, the RStar is a very it's a slippery concept, right? So it probably takes many conferences, dedicated conferences, to answer the question: is it higher? How much? Is it lower? But I think what Charlie said, I think is very, very important. It depends. So suppose it's higher, and I'll say a few words about that in a second, but suppose it's higher. Is it higher because of better productivity or better trend growth, a better economy, better potential growth in general? That's fantastic, right? Or is it, sometimes, though, you hear the argument, well, the higher debt brings with it a higher RStar. That's a premium story. That's not good. Right, so I think we need to be careful how we define that. Is it higher or not? I mean, ask 10 economists, you get probably 20 answers. At the New York Fed, we maintain models, Laubach-Williams and Holston-Laubach-Williams models, and if you check that web page, you see that those models suggest that we are somewhere a little bit below 1% or a little bit above 1%. Of course, there are models that, these numbers are not far different from what they were pre-pandemic. Other models come to different results, and I let economists address that question. But also I would point out to the FOMC own longer run dots, kind of not the same thing, but closely related. In those, I believe the median is 2.6% in nominal terms, right? So not that different either.
The last question. Yes.
Thanks. I think you have said nothing normative about the size of a balance sheet. And is it because this episode hasn't taught us anything, or you actually have a view as a result of what happened?
Yes, I didn't tackle the balance sheet issues. Those are very important. I kind of ultimately decided that was outside of my expertise and page limit for what I was doing. I think the strategy that the Fed pursued, certainly, Jay Powell is the chair that's had to deal with bringing the balance sheet back down to some steady state level and letting it grow from there, and it just has been very challenging in order to find the right level of reserves, to maintain the liquidity, making Roberto's job manageable for everybody and things like that. But what the FOMC seems to have advocated is round tripping QE and the balance sheet. So if you find that you need to do quantitative easing in order to meet your dual mandate responsibilities, you also expect that you're going to bring the balance sheet back down to what its rightful relationship is with the size of the economy and financial markets. You can get more prescriptive than that. You might say, I really don't want to do QE, in which case I think you have to tackle what the inflation objective is and the interaction there. But I think those would be at least some of the issues. And it begets the optics on this, the political criticism has just been tremendous on this. I think that's another reason why round tripping has been an important part of the Fed strategy, at least informally, not written down. Roberto, what do you think? Bill, you have experience here. No,
I think so, a little bit. So no doubt, right, the balance sheet grew to above what was necessary, desire to implement monetary policy. But the committee has said that it intends to operate with a balance sheet, with a level of reserve that is ample. Right? So basically operating either in the flat portion of the demand curve for reserve or right at the beginning of the inflection point. So which means that ultimately the right quote-unquote level of the balance sheet will be determined by the demand for Federal Reserve liabilities. Demand for reserves, but also demand for treasury deposits, demand for currency. Right? So I think those are factors that need to be taken into account. So we were clearly above that level. We still are, because the balance sheet is still shrinking, right? But the ultimate level will be determined, if you want, exogenously by all these other the demand for these other components.
All right, many interesting things to discuss. I have questions for the panel, but I think we need to stop because we're over time. So let's thank the panelists.
Always delighted to help CEPR and partner with CEPR, and there have been several occasions we've had events based around things they published. But in particular, we want to thank Bill and Ángel and Kristin, who generously made sure that we got to do this. Which leads to my second point. I'm going to say something I rarely feel and even more rarely say. This is a project I wish we had done. Usually when other think tanks, other groups do projects, I'm like, we could have done it better, or it's not that interesting. This one was really good and really interesting, and that's commendations to all the authors. I think Olivier and Ben set an interesting starting point, but also especially to the editors, to Ángel and Kristin and Bill. Just a couple substantive points. I think one of the things this project shows, and it's something that's been recurrent in practical research, is that comparative studies, cross-national studies that go more in depth, more case study-like, are worthwhile. When Thomas Laubach and I did a bunch of case studies for our inflation targeting book 20-some-odd years ago, that was derided by some people as loosey-goosey and not very useful. As was seen in this volume and in the previous CEPR effort after COVID on monetary policy and a lot of other work, this can be a very rich way to do economics and a very good collaboration. And so again, I commend the study, but I also just want to say I hope both we Peterson, but more importantly, we the community of applied monetary macro people continue to do work in this vein. And it's great that the central banks have been so supportive of this. That said, I'm old enough to remember that the ECB, for example, commissioned, I don't know, a dozen different networks over the course of 20 years to do, nominal wage rigidity, real wage rigidity, various other things. And we still don't know how the monetary transmission mechanism works. That is, to me, joking aside, one of the very striking things that we've seen in all these studies and recent experience, that a lot of things happened that seem to be immaculate or contrary to logic. I mean, in the US, the one I always fixate on is we raised rates 500 basis points and the interest-sensitive residential housing sector continued hiring. Whereas we used to think that was an early piece of the monetary transmission mechanism. So there's a lot of work to be done, and maybe the comparative studies don't do it. The second thing, just substantively, is it is striking, not just in Ben and Olivier's work, and the work inspired by that, but in general, just how much commonality there was across the advanced economy central banks, and for that matter, the large EM central banks. Commonality of results, commonality of approaches. There actually wasn't that much variation here. Which in some ways is a more powerful statement than you might have thought, because that means that, in essence, what was in our inflation targeting book with Bernanke, Laubach, and Michigan a long time ago, in which I was the only one of the authors at All Skeptic, is really all you need is a credible inflation target and an independent central bank, and you'll be fine. I mean, that, in a sense, if we take the one-sentence version of what we've seen, and that may be too comforting and too easy, and I'm paranoid it is, but that's really what it says. That the central banks could make some mistakes on timing, some mistakes on communication, some mistakes on the forecast, but in the end, once they got going, so everybody was reminded, hey, they have a credible commitment, boom, inflation came down at pretty low cost in a lot of places. And perhaps more importantly, differences in labor market structures, differences in energy market structures proved to be transient. I mean, they mattered, but they proved to be transient in their effect. So that's actually, in some ways, reassuring, but to me, I'm still kind of scared by it. It seems too good to be true, but maybe that is in the end true. And so with due respect to Carolyn and Dave, and in particular Dave's presentation today, I mean, I have to say I'm totally wrong. I've been out there saying I thought the UK was going to have more persistent, higher inflation than some of the other countries because it was smaller, because of Brexit, because of fiscal policies, because of labor markets, because of the NHS. You could make a long list. And it turns out, you know, there are some differences, but to a first approximation, when the Bank of England got going, inflation came down. These things didn't matter as much as I and maybe some others thought. Now, I don't mean to pick on my alma mater, the Bank of England, but just to say that, you know, I thought that was one case where there might have been a bit of an outlier, and it doesn't seem to have been. So maybe I'm going well beyond what Kristin and Bill and Ángel probably would say, but maybe the conclusion of all this is we have something very right. And that's kind of in the spirit of Charlie's assessment of the framework. So my final point is, let's not be complacent. Having spent the last few days talking with officials, hosting them here, and our fabulous conference on structural change that Petra Topolova and Maury Obstfeld organized with the fund, you know, we have a different set of shocks and trends coming. We're going to have ongoing fiscal deficits rising, and as Angel's written about, we're going to have to live with them because nobody's raising taxes a lot in the US or Europe or Japan anytime soon. We have very large industrial policy commitments that may get worse in the dynamic of tit for tat. We have desirable but intermittent relative shocks upward in energy prices that maybe in Europe, they will successfully just have a steadily rising carbon price, but the rest of us, nah. It's going to be a policy here, a policy there, a change here and there. And one thing which we've been emphasizing this week and is going to continue to emphasize, there are going to be inflationary pressures coming out of deglobalization. And against this backdrop, we may have war and geopolitics, and we may have a 1985-like dollar overvaluation. So again, if the lesson of this is have a credible, explicit, well-measured inflation target, do a few things to tighten policy when you have to keep it credible, and keep on your central bank independence, and all will be fine, it may be. But I'd encourage the editors and my team as well to think a bit more about how much, as scary as the pandemic was, this was actually an easy case for monetary policy, not a hard one. And with that, thanks to everyone for participating. Enjoy the rest of your week.